We've seen extraordinary growth. So if we go back to what Citi is, we're essentially the bank of choice for clients who have cross-border needs. We operate in 100 countries around the world with a local bank, and we wake up in about 160 that we'll do business in. But our core clients are 5,000 multinationals, and we move $4 trillion of volume just for those 5,000 companies daily, in foreign exchange, in payments, in trade, and really everything that they need to operate their payrolls and their core supply chains and treasury businesses. That business last year grew its revenues for us by over 30%. I mean, the volumes have exploded as clients have moved around, supply chains have been reconfiguring, additional suppliers have been added in, folk have been looking beyond China to look at not necessarily a pivot away, but what is the additional areas of supply chains that say in India or Mexico, all parts of Asia have been benefiting from as well. So that shift in mix it has been adding growth opportunities, not taking it away, which is not always intuitive.
Those are very impressive numbers. How much of that is the overall size of the pie growing? That is to say, cross-border transactions growing, as opposed to Citi taking market share from others?
We have taken market share, I'm delighted to say. In fact, we're about a year ahead of the plan or 2 years ahead of the plan we put in place a year ago. It says I must have lowballed those numbers. But when we look at it, I think the piece I'm really excited about are the mid-market companies, because what we're seeing is they're either born digital players or they're ones who are participating in expanded global supply chains, and they're growing incredibly rapidly. So that's one of the areas of growth that we see the biggest opportunities. And you see it in the Middle East as they're looking at expanding and diversifying away from fossil fuels, adding more diversity into their economies. We're seeing it in the extraordinary entrepreneurs there are around the world, really taking advantage of the trends going on.
Recession, something everyone's talking about, speculating about, nobody knows. I believe you said in the past, at least, you think it's quite possible there'll be a recession in the United States second half 23. Also, you've talked about a recession in Europe. Is your view on that changing? Because some of the economic numbers are coming in a little bit more reassuring. Some people, even like Larry Summers, he still thinks it's more likely than that, but he's not as gung-ho on recession as he once was. Where are you?
So what we are seeing is different countries are at very different places, so you actually cannot speak in generalities. We expect to see a rolling series of country recessions, but short of anything crazy happening geopolitically, and this time last year we wouldn't have predicted what happened in Ukraine, you've seen the tails come in. So you've seen the over-optimism from some about soft landings and the economy's doing well, but equally you've seen the severe case downside also coming in. I think the general view in the States, certainly one we hold at Citi, is we expect to see a mild recession, largely driven by the painfully persistent service inflation. It's coming off, but it's still pretty high, and we do expect to see central banks continue tightening as a result. But the vulnerabilities that amplified previous recessions around the world are not present. Banks are in very good shape, consumer balance sheets are in good shape, corporate balance sheets are in good shape, and I think that omens well for a mild recessions when they come, rather than ones that we have to be worried about.
Jane Fraser of Citi sitting down with Bloomberg's David Weston at the Year Ahead event. We're hosting over in Davos, Switzerland, at the World Economic Forum. You can continue following that conversation at LiveGo on a Bloomberg terminal if you are a terminal subscriber. TK, a couple of calls there. Tom Keane alongside me. I'm Jonathan Ferro, as you know. Tom, a couple of calls there on a recession, mild, off the back of the Andrew Hollenhorst work
the CEOs
over at Citi.
The CEOs love to talk econobabble there, and of course she's got great ability, from Willem Bouter to Professor Mann, who now is with the Bank of England, on to Andrew Hollenhorst. And he's had a call. It'll be interesting to see how he mends that. But that's not what banking and finance is about. Jane Fraser, folks, is very different than Lawrence Fink, who did the fixed income route. She did the classic strategy route, Cambridge, HBS, the whole route. out McKinsey, and now we go spend a cup of coffee at Goldman Sachs, and was brought in strategically at Citigroup to find a new strategy. And what I find fascinating about Citigroup, and Shonali Basak alluded to this on, I hope I remember it was Friday or Thursday, is a basic idea of what now for Citigroup. They have to catch up with a vengeance with the other banks.
Shonali's going to drop by later in the hour. In the next hour, Goldman Sachs, Morgan Stanley results coming up. Just to wrap up earnings on Wall Street, just to wrap up the price action right now on the S&P, we're down about 0.25% on the S&P 500. Talk through some of these stats. 4-day winning streak on the S&P, longest since September. Believe it or not, on a daily basis, quite remarkable. Weekly gain last week of 2.67%, the biggest weekly gain going back to early November. Futures just a little bit softer on the Nasdaq also. We're down 1/3 there as well. For once, the 2-year last week didn't do much. Pretty much flat on the week, down a basis point or two. Unchanged this morning as well. On a 2-year, 423.21. On a 10-year, 354.39. Yields a bit higher, the curve a bit steeper, up 4 basis points on 10s, on 30s, up about 5 basis points. And just to finish on foreign exchange, we've talked a lot about that dollar story, haven't we? Dollar index weaker since the end of September by more than 10%. Euro dollar at the moment, 108.20, unchanged. A little bit earlier on, it was Philip Lane speaking to the Financial Times. We need to raise rates more. We need to bring them into restrictive territory. That phrase, Tom, sufficiently restrictive.
Yeah.
They've got the depot rate to 2%. I think a lot of people out there at the moment across Europe thinking perhaps they get to 3.25.
Oh, again,
Those ECB officials won't be talking about that number anytime soon, I don't think.
mystery of it, and as we were talking to Elsa Lingos, I think Lagarde is the most under-discussed central bank right now. Christine Lagarde, obviously, at Davos, and I think she was in Brussels over the weekend here with huge challenges, including the small matter of a war. And how do you define their sufficiently restrictive versus the easy game of it in the United States?
So at the end of the year, she was blunt. Really, really blunt, very hawkish, the most hawkish news conference I've seen with President Lagarde perhaps ever in her tenure at the ECB. And that, Tom, was without the enthusiasm, the optimism that we could escape recession. Since then, Goldman's come out with a call and says we can escape the Eurozone recession. Deutsche Bank going into the weekend saying Germany can escape recession. You'd have to think that if we were hawkish in December with President Lagarde, that when we sit down in February, she's going to be even more so, isn't she?
Yes, I think that's fair. And from the good professor from Ireland, Mr. Lane, you see that. He's very astute. It's good to have Philip Lane assisting the non-economist Lagarde at ECB. We're an hour away. We welcome all of you on Global Wall Street, on radio, on television. Many different stories going on today, and one of them is the continued bank earnings of two non-banks, Morgan Stanley and Goldman Sachs. Devin Ryan is expert of this, owned the high ground for years at Sandler O'Neill, and with JMP Securities, a Citizens company, continues his wonderful work. Are Goldman Sachs and Morgan Stanley, are they banks?
Good morning, Tom. So they are banks, I think, increasingly embracing the benefit of stable funding, low-cost deposits on both the consumer side, Goldman now, increasingly transaction banking, et cetera. So I think they're benefiting from that, but, they're obviously huge capital markets players. Capital markets have been pretty challenged over the past year, and we're actually looking for a little bit better year in 2023.
In Davos in previous years, we've alluded to James Gorman of Morgan Stanley as maybe being executive of the decade in finance. That's open to opinion, and different names as well. It's all about wealth management. Is wealth management something that can be, can the Morgan Stanley wealth management success be replicated by other banks who want to be on the edge of James Gorman?
It's going to be really tough, Tom. Morgan Stanley, you made some tough decisions well over a decade ago coming out of the financial crisis to really change the model of the kind of legacy company. And they really ran full speed into wealth management. And with the Smith Barney acquisition, that really was transformational, where now there's such a level of scale. And that's just going to be tough for firms to kind of stick their toe in and try to do that. So we're pretty bullish on that.
You go right where I want to go, which is this idea of scale. Does Mr. Solomon have scale at Goldman Sachs? That seems to be under discussion right now.
Yeah, so clearly the big debate, Tom, is around what's happening in the consumer business. We've actually been a little bit more constructive. I think that Goldman should continue to think about how they evolve and what the bank should look like over the next 20 years. And sometimes the critics, want instant gratification over the next 1 or 2. But yeah, they're coming from essentially a very small base in consumer. They've had a wealth management business for a long time, and it's a really nice business. There's room for them to scale that. I think there's opportunities in areas like custody. And I think that it makes sense. They need to get much more disciplined around their consumer because they have to really watch their costs. And I think that's the big issue here.
Devin Ryan, help Global Wall Street right now. What do they need to look for in the vicinity of 7:30? What is the immediate item of importance for GS and MS?
Yeah, so I think 2 things. One, you can't have a big revenue shortfall, and then that's obviously something that people will care about. But the bigger thing through bank earnings here is the outlook. What are people saying about the economy? And is it a mild recession or is it something worse? I think mild recession is the word you're hearing quite a bit over the last few days here. And I think that's actually a good thing for businesses at Goldman and Morgan as well. So a little choppiness near term in our opinion, but we're more constructive on 2023 than I think most are, particularly the capital markets businesses off of a very abnormally tough 2022.
We're hearing so much more of that over the last couple of weeks. Devin Ryan of JMP Securities. Devin, thank you, sir. Morgan Stanley and Goldman just a little softer in the pre-market, down about 0.4% on Morgan Stanley, down 0.8% on Goldman. Those numbers due in the next 50 minutes or so, TK, to wrap up earnings on Wall Street.
Different companies, and we can wax all we want on the drama of it and the soap opera of it. The overarching theme is everybody wants to do what James Gorman has accomplished. They want to do wealth management because of the persistent fees, the index nature of it, the capturing of BlackRock-like assets, and on and on. And I just, forget about what we're going to see with Ken Leon here in a bit. Going out 2 years, 3 years, 5 years, John, how do they achieve Gorman-like success in wealth management? I haven't figured it out.
Have you got to pay up for it? You've got to go out on the buying spree like Gorman did. And where do you find them right now?
Solomon's doing that in consumer banking, and it's not working out. I don't have the numbers in front of me, but the per account acquisition costs of doing Marcus is difficult.
Well, they're trying to do it organically, aren't they?
Yes, precisely.
That's the big difference.
That's very good. That's very good. Very MBA of you.
Is that right?
Is that
what they do it? McKinsey.
Organically, yeah.
And HBS.
Avocados, bananas. They do it.
What have avocados got to do with anything?
You have breakfast and then you talk about organic strategy.
Okay, nice.
You like that?
And a coffee, and then you move on.
Yeah.
Do they play golf anymore? Is golf a thing?
No, they don't do golf at Davos. We tried that one night at 3 a.m. Barry teed up the ball, and
how did that work?
It was good. Rachel had the 4-iron out, and shanked it. She hit the guy from Coldplay. She hit the guy from Coldplay in the head with a golf ball.
The lead singer.
Yeah, he was downfield. And
do you remember the night I almost broke my hip?
Yeah.
Good times. Okay.
I remember being horizontal in a Mercedes. Me, I could barely fit in.
Oh, because you had to lie across the back.
And I can't remember his name. It was Peter. I don't remember his last name. Peter was in the front seat, holding my legs up just to be sure I could get home.
I'm sure that was quite a night, Tom.
It was. Well, the sun was coming up.
7:30 Eastern Time. We're going to catch up with Ken Leon, the Director of Equity Research at CFRA. It's about 6:41 Eastern Time right now, so only about 50 minutes away, 49 minutes away to catch up with Ken. Off the back of numbers from Goldman and Morgan Stanley, Johnny Bassett's going to drop by the studio in just a moment to break down them when those numbers come through. Equity futures right now on the S&P. We're down about 1/3% on the S&P 500. No real drama here. Yields a little bit higher at the long end. Curve a bit steeper. 10-year 355.13. Yields higher by 5 basis points. And crude with an 80 handle on WTI. $80 and about 20 cents. Crude up 0.5% from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. In the Ukrainian city of Dnipro, rescue crews are still searching for 25 people missing after a Russian missile hit a 9-story apartment building. At least 41 people were killed and dozens more wounded. Now, for the first time in 6 decades, China's population is shrinking. It's the latest milestone in a worsening demographic crisis for the world's second largest economy. Government data says that at the end of of last year, China had over 1.4 billion people. That's 850,000 fewer than the year before. The number of births was the lowest since at least 1950. A new report says that international trade will grow more slowly than the global economy after most of the next decade. According to the Boston Consultancy Group, the war in Ukraine will reshape strategic alliances and alter the flow of cross-border commerce. The report forecasts that trade will grow at an average of 2.3% through 2031. In Venezuela, public sector workers mounted the biggest anti-government protests in years. Workers organized at least 50 protests yesterday in Caracas. Teachers were joined by nurses, pensioners, and others demanding more money from the government. They have been falling behind in an economy that embraced the US dollar. And Microsoft says it will add the virtual artificial intelligence bot ChatGPT to its Azure cloud service soon. The company already has a relationship with the bot's owner, OpenAI, and may take a larger stake. Bloomberg has learned that Microsoft may invest as much as $10 billion in OpenAI. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I do think that the opening up of China, the impulse it gives to consumption in China, energy need, commodity need in China as well, I do think it's a very good signal. It will be supportive of a momentum, but the true inflection point we have not kind of seen yet. We have certainly advised them to go long on China and to be overweight on China.
They're not the only ones. That was Ralph Hammers, the UBS CEO, sitting down with Bloomberg's Manus Cranny in Davos, Switzerland, a little bit earlier on. China GDP coming in better than estimated for 2022, but the economy growing at the second slowest pace since the 1970s. Big banks betting on a stronger recovery in the coming months. Standard Chartered, one of them, Morgan Stanley, another. Bank of America expecting growth of 5.5% or higher. Tom by year end. Punchy calls that just weren't there several months ago.
I like that. Punchy calls is the right way to put it. And all of a sudden, we're beginning to model out 5. And who was it? Somebody had a 6%. Ed Hyman?
Evercore.
Yeah, Evercore.
It was Evercore. Julian Emmanuel sat in that chair and said 6 handle on China GDP.
Yeah, well, there's the recalibration here back to something that we remember. Enda Curran is acutely aware, as our chief Asia economics correspondent, it is not the past. And over the weekend, the bombshell that it is a China with changed demographics. And let me cut to the social chase. There was codified out of the time of Mao of one child. And a number of years ago, I'll guess 10, there was some form of amendment to that. Does China need to be a 4, a 5, a 6-child family nation?
Well, certainly they are now seeing the end result of that one-child policy, Tom. Like you mentioned, we had these population figures out making the point that China's population has shrunk for the first time since 1961, when China had a great famine, of course. It is the legacy of that one-child policy that did change over the past decade or so, 2-child and a 3-child policy. And of course, now the authorities are trying to encourage people to grow their families, to have more children. They're offering subsidies and the like. And obviously, it's going to become a pressing concern for them because the working age population is shrinking. There are more deaths than births.
Yeah.
Of course, we're also in the middle of this public health crisis. We don't quite know what level of fatalities China is experiencing. So it's a much more important structural negative for the economy than the day-to-day headlines around the COVID-0 impact.
What's so important here, and for those of you on radio, the slope, the degree of change of births in China is pre-COVID, and it is stunning. That is the correct mathematical word. I hope that John Farrell will let me use the word stunning. And Curran, what do they do as a social policy to increase births? Is that a new safety net that Xi has to come up with?
Well, they're talking about subsidies. The authorities are looking for ways to coax families to have more children. But of course, people are more reticent now. The cost of raising a family is more expensive. Typical living pressures like work, commuting to and from work and everything else that you experience, not just in China, of course, but around the world, marrying later. All of these social trends are weighing against expanding families in China. And that's now really coming home to roost, and I think is going to be a major headwind for economic policymakers in the years ahead.
John, look to the Northeast, Japan, Korea. That's what they're worried about.
I want to finish on population growth just briefly. Ender, I wonder what's more important here, the overall population growth or the urban population growth? Ender, is the latter a little bit more important? Is that what you focus on?
Well, it's the labour force that you really focus on, John. It's, as you say, it's not really the absolute size of the population. It's what's happening with your labour force. How productive is your labour force? How skilled and how educated are they? I mean, there's an argument saying that it's not necessarily about where the headline rate of employment is going for China. It's what are they doing with those who can work? And of course, the workforce in China is shrinking. And that's what's really alarming people. And the concern is that they are on a similar path, like Tom just mentioned, to other neighbours in Northeast Asia.
Chinese Vice Premier Liu He speaking in Davos, Switzerland at the moment. Tom, here's a headline for you. Life has been restored to normal in China. Life has been restored to normal in China. That headline just crossing moments ago.
And is it normal?
I can't speak for all of China, Tom, but it certainly is a lot better in Hong Kong. Airport is reopened, the crossing in the Shenzhen is reopened, but there's still a fairly subdued feeling here. I think we need to get over Chinese New Year and then see what the mood is like then.
John, I just think, you, me and Lisa in Hong Kong.
You want to go?
I just think it's a celebration
I don't know if
of
I'll
our
get,
team in Hong Kong.
I don't know if I'll get
so hard.
the invite, considering the question I'm about to ask. He also reiterated China opposes unilateralism and protectionism. Ender, can you make sense of that for me? How could a Chinese official seriously come out and say that they oppose protectionism?
Well, quite right, John, but this, of course, we all know what the backdrop here is. Chinese officials have typically used Davos as a platform to sell itself to the rest of the global economy, that they're open for business, that they operate by the rules of the international liberal rules-based order and everything else. And this is a line they've trotted out before, but of course, it's specifically being aimed at the US. They are pushing back against those tariffs. Remember now, he's going to be meeting the US Treasury Secretary over coming days. You can be sure part of that conversation will be tariffs on Chinese goods. So I would imagine he's just setting a bit of mood music ahead of those talks.
He knows his audience. And thank you. And Karen, over in Hong Kong.
Ender's got the best definition of Davos. It's mood music.
It's mood music. It often is, right? Music. Isn't it always just mood music?
Yeah, my answer is when you're traveling is usually they play Fleetwood Mac. The only difference is
that your
rumors favorite? No, it's not my favorite. That's what they play. It's just that's the mood music.
Opening up is a key driver of economic progress. China will always promote all-round opening up. That's the kind of thing the West wants to hear in Davos, Switzerland.
It's like what Mr. Fink was talking about.
TK, what happens exactly? What happens off the back of it?
Well, everybody goes home and tries to make the next marginal profit dollar down the income statement. That's what they.
Are we really going to take headlines like that at face value? That
no, we're not. That's our hallmark, John. No, this is what we've done for 20 years. John hits the third rail here. This is what we've done for 20 years, is we don't take it at face value. We respect that they go. I respect that they go there. I love beating up on David Rubenstein, just as an example, but, you know, he dishes it right back. These guys, that interview we did with Moynihan there a year or 2, 3 years ago, that was on
several
fire.
years ago, yeah.
We talked to a banker about banking. That's what, you know, that's what they don't. They want to talk about hope and.
Do you remember? I remember when President Xi, the leader of the Communist Party,
place stopped,
and China, spoke to the audience at Davos. He was that
place
big speaker, and then all these articles came out that China was kind of the new flag bearer of the global liberal order. I mean, what on earth was that nonsense about? I mean, I've been there. I've been on both sides of the wall. Been inside the World Economic Forum, outside of the World Economic Forum, and just sometimes people seem to get carried away with what happens there. Don't you think?
Yeah, you know, I mean, I've seen you outside the wall there. Those 2 hockey players, really good hockey players, you know, they got their place down there. They go from DLD in Munich and they come up to Davos. There's a whole Davos, folks, outside of the World Economic Forum. Shh, don't let them know. There's a whole second Davos going on right now.
What's the second Davos? What does
different
that mean?
tinge. It's a lot of people on business and building relationships and all that, and there's a lot of hangers-on, just like you'd think at like a rock concert or something like that. That's sort of maybe very crypto-y and that. And then there's a lot of other people just there to be there, looking to make 1 or 2 relationship contacts. I mean, I get stopped in the street constantly by people. I have no idea who they are. Usually he's trying to sell me BitDog or something, you know.
And you never bought?
No, I don't. I have my crampons on. I got the little, you know, sticky mountain
The spikes?
things, the spike.
That you put your boots in?
Yeah, I wear them for like 5 days straight.
I've never seen them. Okay. All right.
They're on a set
Should
too.
we leave that conversation now? I feel like that's died.
Yeah.
Equities right now
yes.
on the S&P down 0.2 of 1%. Coming up, Chris Harvey, the head of equity strategy at Wells Fargo Securities, going to join us in just a moment.
Important conversation.
Look, on the road ahead, we've got Mike Wilson and Morgan Stanley out early this morning.
Yeah.
Basically saying, and I love this line from Mike Wilson earlier this morning from the team at Morgan Stanley, bear markets are like a hall of mirrors designed to confuse investors and take their money. Yeah. Isn't that a great line?
Yeah, it is. John, we're about ready to round it up. $86 Brent crude is at the backstory 4 days from now in Davos.
Goldman. You saw what Goldman said in Jeff Curry, didn't you? They see a bullish concoction. A bullish concoction.
That's Chicago talk.
Commodities.
You know,
is that what that is?
That's what Krasner would say.
We're going to try and catch up with Jeff later this week, hopefully.
Yeah, we hope so. We're working on it right now. A lot of good oil voices to talk to, including our Javier Blas.
Cool, very cool. Okay, so coming up shortly, Chris Harvey of Wells Fargo to break down the equity market. In the next hour, you'll get results from Morgan Stanley and from Goldman Sachs as well. Shanali Bassett's going to drop by the studio and bring you the latest numbers on all of that. We'll tie that all together and push forward to the tech results as well. Just to get you started, and welcome back from a long weekend if you're joining us stateside. In the equity market at the moment on the S&P 500, shaping up as follows on the S&P. No real drama here, down about 0.2%. Equities lower, soft and negative by 8 or 9 points on the S&P 500. Yields a bit higher here by 5 basis points, 355.50 on a 10-year. Euro dollar not giving me much, 108.26. Those of you interested in the data, retail sales a little bit later this week. Interested in the Fed speak? You'll hear from Mr. Williams of the New York Fed. Some welcoming remarks a little bit later on this morning, I'm told. That's scheduled for about 3 p.m. Eastern time. The New York Fed's John Williams, Tom, giving some welcoming remarks a little bit later. We'll see if he talks about monetary policy or not. Live from New York City this Tuesday morning. Good morning to you all. This is Bloomberg. You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Most fascinating entrepreneurs because you also started really young. What did you learn? Did you always think that you'd be an entrepreneur?
Probably, yes. I think, which is a bit sad,
From
isn't it?
age, what, 5,
Well,
6?
maybe, I'm not sure. I come from a family of entrepreneurs, so even though I probably can spell the word and still can't occasionally, it's sort of in my blood. But I mean, it's really fun starting a business. And fun growing a business. I feel it's a real privilege. And I started my business officially at 18, but I think I knew I wanted to do it very differently from about 15. But I'm sure it's, if you're surrounded by it, it feels very natural. So yes, it's fun.
And it started how? You started by you went to Florence. It was in Italy, and you started handbags.
Yeah, so I knew I was actually given a handbag by my mother when I was about 16, one of her old handbags, and I remember how it made me feel, and I think fashion is fascinating for the mood-changing, the confidence-boosting aspects, the sort of tribal aspects of what fashion does. And so I went at 18 to Florence, knowing that was the home of leather goods, which is what interested me. I just wanted to learn, actually, and be surrounded by craftsmen who are making things as important, and that's going to be very interesting, I think, over the next sort of 10 years. I think the onshoring of craft and manufacturing is going to be fascinating, actually. I mean, I watched the offshoring. I literally saw it, and I think we're going to be seeing that coming back to local. We have to. When we're all looking at our objectives in terms of carbon, proximity is going to be key.
A special Wall Street week from the World Economic Forum in Davos, Switzerland.
This is Bloomberg Wall Street Week. I'm David Weston.
Join Bloomberg's David Weston as he engages with the foremost business, political, and cultural leaders for discussions on wealth inequality, global power dynamics, and more. Accountability, solution-driven conversations, data insight. This Friday at 6 p.m. Eastern, only on Bloomberg Television and Radio, your global business authority. A multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
Pull the camera back and think long term.
If we do go into a recession, it will be a mild one.
Consumers still seem to be spending. The labor market still seems to be strong.
You could have goods deflation this year. That is a very different story to last year when U.S. inflation was accelerating.
We're getting more confidence, especially for the large banks.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Later this hour, wrapping up earnings on Wall Street with Goldman and Morgan Stanley. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance with Tom Keene. I'm Jonathan Farrow. Equities negative just a little bit, TK, down 0.2%. Earnings a little bit later this hour.
Got a Monday feel, but it's Tuesday. It's going to be an interesting 4-day weekend. I love what you mentioned at the end of the last hour, John, is the hallmark this week. It's not going to be CPI Thursday or this, that, and the other thing, but it's going to be about 70% of the American economy to get that we're all going to die and have a recession call readjusted, recalibrated.
You don't hear much of that anymore off the back of the rally we've seen. Hey, the rally in EM, the rally in European equities. I mentioned it a little bit earlier this morning. I'm going to go on and on about this. We've had 9 trading days. The Euro Stoxx 50 is up almost 10% year to date.
Yeah, I'm around it. As I mentioned,
move.
The equity market, absolutely, with 21, 22 VIX coming into an 18 level. Right now with some Monday angst, 20.04, right on the cusp of a 19 handle. But, as Chris Harvey mentioned, it's been growthy versus the value certitude that's out there.
I should specify we've had 9 trading days stateside, of course, and high yield spreads, Tom, are much, much tighter as well, by more than 60 basis points year to date. So it's not just EM, it's not just European equities, it's high yield credit, junk bonds in America too, where there's a really sizable bid. Dollar's weaker, commodities are rallying. I think copper's rallied by almost 9% year to date as well. Yeah. Just getting balled up on a cyclical story off the back of China reopening.
Absolutely, and last night Brahma was at the Belvedere bar having some of that famed barley soup, $30 for a small cup of it. You'd love it, John. And the answer is Brahma brought the bar to a complete silent moment, talking high yield spreads coming in.
Pain trade.
Pain trade.
Pain trade.
Pain trade.
Risk assets go up from here. Bank of America with a fund manager survey a little bit earlier this morning saying exactly that. The pain trade is that this continues. I mentioned Mike Wilson and Morgan Stanley. Here's the note from Mike this morning. Here's the full note, the full quote, the lead paragraph. And I'll get to Chris Harvey of Wells Fargo on his view on this. Bear markets are like a hall of mirrors designed to confuse investors and take their money. He went on to say, trust your fundamental process for us. Margins and earnings are likely to significantly disappoint whether there is a recession or not.
And what's important here is the timeline. Mike Wilson's idea of long-term within, the structure of a big Wall Street firm is, I'm going to say 6 months, 9 months, maybe a year. What do you do, John, if you have a longer-term time frame, 3 years, 5 years, coming out of a pandemic, China reopening, you've had this nice gift of a lift, then what? And that's sort of where we are going into February.
Let's do some of that right now with Chris Harvey, the head of equity strategy at Wells Fargo Securities. Chris, let's start there. Bear markets are like a hall of mirrors designed to confuse investors and take their money. Is this a bear market rally?
Bear market rally. This is a rally, no doubt. Has a lot of the hallmarkings of a January effect, as you were pointed out. Credit spreads are tightening, high yield, IG, but risk is rallying, smaller caps are rallying. I don't know if I'd call it a bear market rally. What I think is we're probably going to begin to stall out here. We think fair value in the short term is somewhere around 4,000. And at the end of the day, it's true that not credit spreads, but margins are going to compress. EPS is going to come down. But we think we're really facing more of an economic malaise than we are some sort of sharp recession. And so as a result, you have to be careful. You have to place your bets. We think mid-cap growth is that sweet spot. And overall, the broader market's a little bit tough. We think things will trade higher, but you can see a pretty big downside from here.
So, Chris, within that, there was a call on the economy and there was a call on earnings. Can we just separate the two just for a moment and focus on earnings, Chris? What kind of earnings are you expecting this quarter and the outlook for the rest of the year?
Yeah, so let me say this. For the last 2 or 3 quarters, there's been a lot of fear-mongering coming into earnings, right? And so when you fear-monger, what happens is you lower expectations. We've lowered expectations so much in the last couple of quarters that the numbers haven't been great, but the phrase, things are better than expected, has been true. And I think that's going to be true this time around. We are going to see some margin compression. We are going to see some revisions down, but now's not the time where you really lower guidance because the economy's still okay. What we're worried about more so is when you report first quarter numbers. But right now, we think things will be okay for now, or better than feared is probably the right word.
Christian, in your beautifully concise note, you speak of a tactical shift. And I get that there's been a tactical shift. Everybody's gotten this mother of all recession calls, wrong, wrong, wrong. Help me with April, or May is June. How do I prosecute tactics now to survive into second quarter?
Tom, that's a great question. And that's a question that we're having with a lot of clients. We had a lot of clients that performed quite well last year come into this year, and they've just gotten run over. And what they're saying is, hey, do I turn? Do I shift? Do I tactically move? And our answer is no, right? Because ultimately, we're going to see some sort of downside. We're going to see some sort of pain, whether it's economic, whether it's earnings, or whether it's macro. And so we have 12 months, 11, 12 months in the year, too early to shift. And there's a lot of room between now and then. So at the end of the day, we're having a bounce.
Right.
That bounce we kind of understand, but ultimately the worst isn't over just yet.
Chris, the financial media is guilty of this, and frankly, Bloomberg and myself, we're as guilty as anyone of a complete focus on the big banks, and what Wells Fargo's doing and the rest. Okay, great. After the big banks, which earnings matter to you?
So what we're looking for is we're looking at cyclical earnings because we think that's where the pain is going to be, right? Cyclical earnings, the old economy stocks outpunched their weight last year, and that's where we think the pain's going to be. If you're going to believe that the economy is slowing down, which we do, that's where you should see most of the pain. That's where we should see the margin compression, and that's where I think stocks are most liable.
Chris, are banks part of that cyclical story that you just described?
Yeah, banks are part of that, but we're not as worried about credit as other people because one of the reasons being is the job picture is much better than many people expect. And we expect the job picture to be pretty robust, at least for now. And so as a result, credit should be okay. And what we've seen so far is credit's not great, but it's normalizing. It's okay, or it's where it should be. It's not worse than expectations.
For a long time, we used to talk about tech as the secular growers, these big things that didn't worry about the cycles of the global economy. Chris, do you think those tech names are now cyclicals?
So, some of them, if you look at semis are definitely cyclical. Software, I'd say less so. And one of the things that we're seeing is a lot of industrials are becoming a little bit more growthy. And here's the thing. The big debate that we're having right now is what takes leadership? Is it energy? Does tech come back? And what we think is it's going to be a lot more idiosyncratic market. Don't look so much for this one big trade or this one big knockout. Really get back to the fundamentals. Look for that good risk reward. Again, we think it's in that mid-cap growth space, and you can get some good valuations down there, 15 times earnings or so. And don't focus so much on the macro.
Okay, well, that's great. I'm focusing right now on S&P 500 up 4.2% in, 9, 8, 10 days, whatever we've had this year. Are you going to give me a double-digit return in 2023?
So what we think in 2023 is ultimately you're going to get to 4,200. You're going to get to 4,200 because we think rates are going to come down. We think inflation is coming down, and we think the economy is slowing. And what is that? That's a growth market. And what is the S&P 500? That's a growth indice. And at the end of the year, even if the Fed doesn't cut, which we don't think it will cut, the market will believe that it's going to cut. And we should see that reflected in the shape of yield curve and interest rates.
Zion, go to Chris on this. This is the heart of Bloomberg surveillance. Do we have two opposing views here between what we see from Wells Fargo and what we see from Morgan Stanley? Couldn't be farther apart.
Are you talking about the path or point to point?
Both.
Because the shape of the path, I mean, Chris, didn't you talk about a potential for real downside here in the near term at least?
That's right. We think there's downside to 3,400, but ultimately you do recover, right? We do think that we end up higher. 4,200 is the high for this year, and we do think we get there. We think that, again, what you're facing is more of an economic malaise, not a sharp sell-off, not something that's going to be horrific. And as a result, we can muddle through that. And let's not forget, the Fed is going to, or we think the Fed's going to stop raising rates sometime this year. That's a positive. And if we get through a situation where it's more of an economic malaise than a sharp sell-off, then earnings, they'll be dented, but they won't collapse.
Hey, Chris, enjoyed this. Thank you, buddy. As always, Chris Harvey there of Wells Fargo. So point to point from here to year end, looking for 4,200, looking for downside to 3,400. Tom, I can tell you, Greg Bowdle over at BNP Paribas, he thinks we end the year there, 3,400 on the S&P. That's your range of calls out there at the moment. The average, if you want the average, Tom, for year end, is just north of 4,000.
I really thought about this a couple hours ago. I mean, being a strategist right now is brutal.
Sucks.
You've got a supply side. That's a nice way of putting it. You've got a supply side. Seriously, you got a supply side shock in an historic moment, a once in a lifetime pandemic, and you're supposed to game economics and central bank dynamics with a fixed income market always placed before equities, bring it over down the income statement to the revenue line, and hopefully the distinction of profitable and non-profitable companies. It is really difficult.
It's really difficult. I keep going back to this, Tom, and it depends what seat you sit in. We can have a conversation about what is good versus what is bad, and we can have a market conversation about what is getting better versus what is getting worse. And I think capturing that this morning was the fund manager survey that came from Bank of America. First line for you, Tom, in this quote, and that 50% of fund manager survey investors expect a weaker economy in the next 12 months. That's not good. That's bad. But is it better? It's better. This is actually the most optimistic FOMS investors have been on global growth prospects in the past year. That's captured by the fall we've seen in cash positions. It's captured by the increase we've seen of people who want to be in EM, in cyclicals in Europe.
And I'm going to call a value bet at the end of last year as a general statement. And so far, we've had a certain level of growthiness. I'm fascinated by what the big techs do. I mean, they're all laying off and doom and gloom and all this. And I have no idea what big tech's going to give us here in a couple weeks.
And neither do I. Apple in early February, that's going to be the first stop. I've had a lot of people message me about this, Tom, and I think this is important. We're talking about all these banks saying buy risk, buy EM, buy Europe, buy cyclicals, and then the people leading those banks are making decisions to cut people off, increase reserve for losses potentially later this year. The leadership's become very defensive.
What you don't mention is not mentioned at the meetings of the World Economic Forum is in 17 minutes, they're going to sell to the street how profitable and responsible they are while they cut the bonuses of the people not going to Davos.
Precisely. About 20 minutes away from here and from Goldman
I couldn't
Sachs
get the Gulfstream
and Morgan Stanley.
Couldn't land it.
Equity futures on the S&P down 0.2. This is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. In China, the economy proved more resilient than analysts forecast. Last year's GDP growth of 3% was the second slowest since the 70s. Still, data from the fourth quarter and December came in better than what economists had expected despite a COVID outbreak. That suggests the worst of the slump may be over. Meanwhile, trade between China and the US is on track to break records. US government data through November suggests that imports and exports in 2022 will add up to an all-time high. The final report is out next month. Here in the UK, teachers are joining other workers who have gone on strike and they fight for higher pay. The teachers' union says members in both England and Wales voted overwhelmingly in favour of industrial action. Meanwhile, nurses do plan to stage another walkout next month. The chief economist of the European Central Bank says interest rates will have to move into restrictive territory to tame inflation. Philip Lane told the Financial Times we need to raise rates more, but he also said that policymakers need to be flexible in both directions. And it's a rare case of an activist targeting a prominent Chinese company. Meme stock investor Ryan Cohen has taken a stake in Alibaba and wants the e-commerce giant to buy back more of its shares. That could put Cohen at odds with China's President Xi Jinping, whose administration has wiped out growth at Alibaba and other big tech companies. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
Countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis, weekdays.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
From the world of politics to the world of business, Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg. Tuesday, a Bloomberg exclusive live from Berlin, where German Chancellor Olaf Scholz sits down with Bloomberg editor-in-chief John Micklethwaite. A wide-ranging conversation only on Bloomberg, your global business authority.
The number of billionaires went up during the recession. Up. They didn't go down, they went up. Raising taxes on working families, making inflation worse. Let me be clear. If any of these bills happen to reach my desk, I will veto them.
The President of the United States.
It's whispering.
I know. It always gets me. The president on policy on the other side of the aisle. AMH is going to join in just a minute.
John, someday I'm going to be as old as President
Are you going to
Biden,
whisper
and
that?
You're going to be
Will you
here.
whisper?
Shonali's going to hold my walker, and I'm going to be here. Watch the yen.
Are you going to whisper for emphasis? AMH, your mic is hot. We'll get you in a second. Equity futures, negative 0.2 on the S&P 500. TK a little bit later this hour. We'll catch up with Shonali in a few minutes' time. Goldman, Morgan Stanley, just around the corner.
And just around the corner, 7:17. Let's get very quickly here to Anne-Marie Horton in Washington. What is on the president's agenda today, Ms. Horton?
Well, it's definitely not watching the yen. Sorry about that. The president today is going to be sitting down with the Prime Minister of Netherlands, Mark Rutte. And this is, of course, they're going to talk about Ukraine. Netherlands has sent about $3 billion. Potentially there's going to be another billion on tap. It comes on the heels of his phone conversation the past 24 hours with President Zelensky. But also, what we spoke about the last hour, also on the agenda, is the fact that the U.S. wants to make sure Netherlands is on board with curbing some of this advanced technology for semiconductors to China. This is a big deal in Netherlands because one of the crown jewels of their economy is ASML. So this is an important meeting the president's going to have, and it comes on the heels of his meeting with the Japanese prime minister, who they are also trying to coalesce around this.
Very quickly, Anne-Marie, as we wait for Goldman Sachs to come out, the horror that I observed this weekend in Ukraine was it the worst ever? I can't go there. I'm not an expert. How does the president adapt and adjust to what we saw this weekend with a missile that can take out an aircraft carrier?
Yeah, and also, of course, that civilian infrastructure building, which the death toll we saw rise again this morning, and included a number of children, incredibly devastating images, absolutely horrific, to be frank, coming out of Ukraine. I mean, the president, the United States has recently sent a number of advanced equipment, including the Patriot missile battery. The news really over the last 48 hours was that the UK is going to be sending these tanks. And there's a lot of pressure now stepped up on Germany to send also Leopard tanks. So I think those images are going to dictate and maybe push some that are still waiting on what they potentially may or may not send into the direction of potentially sending those weapons.
What a time for a conversation with Chancellor Scholz a little bit later today, sitting down with our editor-in-chief, John Micklethwait. AMH, Anne-Marie, over in Washington, D.C. Anne-Marie, thank you. This from Citi's Andrew Hollenhorst, Tom, just moments ago. I think Jane Fraser referring to some of his work in her interview a little bit earlier on this morning with David Weston, Tom. Our base case remains 50 basis points for the February meeting, despite the modest probability being priced. We think policy rates end the year comfortably above 5%, in contrast to this market.
We got data out to February 1. I'm going to say what I've said before. People make fun of me about it. We're massively, massively data dependent for retail sales, the dynamics there of the control sale, and just at all, we're data dependent. That's all there is to it, between 50 and 25 basis points. Right now, we're very data dependent.
Waiting for some data out of Goldman Sachs, and it drops right now. The fourth quarter EPS coming in at 3.32. I'll get you a comparison to the estimate in just a moment. Net revenue 10.59 billion, the estimate 10.7 billion. Provision for credit losses $972 million. Loans 179 billion, the estimate 178.67 billion. We're looking for some of the trading numbers, as always, with Goldman Sachs. And Shonali Basak alongside me, looking for the same thing. Hey, Shonali.
Listen, they just came in blowing through estimates. When you look at that trading data, it's interesting. This year is the year to ask whether this is sustainable, whether you can keep on inking $3.5 billion a quarter in the fixed income unit. Remember, that is a much bigger number than we're seeing over at peers. You also see Goldman Sachs coming in above line when you look at the equities trading revenue. When we look at Morgan Stanley, we're going to be watching for another quarter if Goldman is coming in ahead of them on that regard. You're looking at net revenue, however, overall coming in a tad shy of estimates, John. So when the rubber hits the road for Goldman Sachs, are they going to be judged on the core businesses that they come on beating on very strongly here, or are they going to be judged here on some of these moonshots that they are looking to now reorganize quite a bit?
Well, let's talk about the different parts of the bank, Tom, just briefly. Fourth quarter IB revenue comes in at 1.87 billion, the estimate 1.64 billion. Unsurprising, Tom, given the year we had in markets last year, bonds down, equities down, to see this line, significantly lower revenues in asset and wealth management?
Well, they're going to partition out, and that's what they do, folks, in a PowerPoint. I mean, I'm looking at 14 pages of data in detail here. Shanali, do people look at this as a normal analysis day, or is it completely focused on Mr. Solomon's consumer experiment?
There's a lot of questions about the consumer experiment and where they make money from above and beyond that. So the asset and wealth numbers increasingly important as we truck along here. Now, to the point that you're making, this is a tough business for everybody. But at the very, very end of the day, no matter if you're playing in asset or playing in consumer, let's talk really quickly here about the ROE number. The number that we're looking at here of 10.2% is well above estimates. The expectation was 7%, but you are watching Goldman Sachs come down to earth quite a bit. Remember, last year they inked a number there at 23%. So what is normal for the Solomon era? The medium-term target is 13%.
Can you compare and contrast the numbers we're seeing with the decisions that they're making in the C-suite at the moment? Compare and contrast this report to some of these severe cuts we're expecting to the workforce.
You know, it's funny. I was looking back 5 years this morning just to kind of reminisce about efficiency ratios over at Goldman Sachs. And the reason that's important here is because Goldman Sachs is more efficient than Morgan Stanley. Their numbers are better on efficiency. However, because the ROE is not coming in as hot, you have questions about how you bring that overall profitability up at Goldman Sachs. The reason I bring this up is because those 5 years ago, you did not see that efficiency number posted at the top of the release. And now you certainly do. So those cost cuts are very important over there.
I want to bring up a banner here. We're running the red banners. For those of you on radio, we're running the red banners here. Brad, this is so important. We got to put this banner up. And I heard this from Goldman Sachs Bulls over the weekend. Shanali, right in, and I give them great credit for doing this. Net revenues for 2022, Platform Solutions, I still don't know what that is. Platform Solutions is 3.17% of net revenues. We're talking about, Marcus, and the rest of it like it's 30% of the bank. It's a rounding error. Why are we so upset if it's 3.17% of revenues?
That is the favorite question.
Did I do okay? I'm sorry. A guy said to me, it's minuscule.
There was a presentation earlier last year that showed you that $100 billion in deposits they had brought in through that business also changed their funding mix quite meaningfully. So to the point, it's a small business. It loses a lot of money. We had a banner below showing the provisions for loan losses at that business. That is part of the costs in addition to the overall cost you're seeing at that business. So yes, that's why I was saying, Tom, that this asset and wealth management business becomes all the more important. And if you look at it, even though you see pressure on the fees, you do see the business come in above expectations on revenue at asset and wealth.
Are they going to be organic in wealth management, or are they going to do an Eaton Vance? Eaton Vance, folks, is a wonderful Boston shop that Mr. Gorman picked up. Can they find an Eaton Vance, or are they going to grow it?
You know, it's interesting. There's this young chap there called Julian Salisbury, and the focus there for him is not just what you're seeing over at Morgan Stanley, passive, starting to float into all these banks, but there's a line here that talks about their private investments, equity, debt, the decrease in equity values and the decrease in debt investments. This all comes as you're watching Goldman Sachs look a little like KKR. They're focusing on private markets over at that asset manager. It's a competitive business, it's a higher fee business, and that's why it matters.
There's some people who want to be paid a little bit like maybe some people at KKR as well, Shanali. Let's start Goldman's down about 1% in the pre-market. Your broader equity market still down about 1/10% or 2 on the S&P 500. That's Goldman, one still to go. Morgan Stanley, Shanali's not going to go anywhere. We'll break down those numbers when they come through, and we'll catch up with Ken Leon, the Equity Research Director at CFRA. All of that still to come. Equities down, as I say, but trying to recover by about 1/10% on the S&P. Alongside Tom Keene, I'm Jonathan Ferro. This is Bloomberg Surveillance.
Humanity consumes 500 billion cups of coffee every year. That's almost double what we consumed a decade ago. And yet, coffee production is one of the most antiquated industries in all of agriculture. Climate pressures like drought, heat, and blight are affecting food producers in different ways all over the world, as climate change becomes something we can taste. In the past year, hundreds of thousands of acres of coffee plantations were wiped out. What's at stake are the livelihoods of around 125 million people. Because, if you're being honest, this is a plant that cannot hold on much longer in a changing climate.
Goldman numbers out just moments ago. No real drama here. We're down about 1.7% in the pre-market. I'll keep an eye on that for you. Morgan Stanley earnings still to come. Shanali Basak alongside Tom Keane and myself will break down those numbers for you when they come through. Equities shaping up as follows on the S&P 500. We are negative by a little more than 0.1% on the S&P after a 4-day winning streak on the S&P 500. On the Nasdaq, down about 0.2%. In the bond market, for once last week on a 2-year, a little bit of a snooze. Your 2-year right now, 423.21. Getting some numbers from Morgan Stanley at the moment. Fourth quarter net interest income, 2.32 billion. The estimate 2.5 billion. The all-important wealth management net revenue number, 6.63 billion. The estimate 6.14 billion dollars. Going through some of these numbers for you, as I say, Shanali Basak alongside us. Shanali, what do you see?
I think one thing important here is the fixed sales and trading revenue missing expectations. When you had Goldman just come out with not only a beat, but the biggest jump on Wall Street at 44%. So what are they going to do over there to get competitive in fixed income? The other question I have is about equities sales and trading revenue. You have it come in below expectations at $2.2 billion just about. Remember, that is the king on Wall Street typically coming in higher than Goldman Sachs by absolute numbers. So they still inked out a gain there. But again, why the miss is the big question here. So, kind of mixed results here if you look overall. The trading desk, obviously, the reason it's important is a twofold question. One, performance in a tough market for equities, but also because, remember, we had Jonathan Pruzan over there on his way towards stepping down this month over at Morgan Stanley. Puts a lot of pressure and a lot of spotlight on the other two major deputies here, Ted Pick over at the trading desk, as well as Andy Saperstein over at the wealth management business, as we've been talking about getting more and more competitive by the day.
I look at the return on ROTCE, return on capital, and some of the other measurements here, and the answer is they're just simply more profitable than Goldman Sachs. Is that the short answer?
They aim to be, is the question here. In a few minutes here, we'll also look at the post that they put out for their strategic objectives. They tend to do that at the end of the year to see if anything has changed. But if you look at their medium-term goals, they are in line at the high end of the range. They're higher than what Goldman Sachs has targeted to give you. But today, at least, they're not, Tom. They're slightly below in return on equity where you see Goldman Sachs.
And to their credit, John, like all the banks, are really getting much better clarity on these releases of tons of data. John, a single sentence. The wealth management business delivered 6% full-year annualized growth rate from the beginning of the year. Now, I believe the stock market was down 20%. I believe the bond market was down 14%.
Battered.
I think I'm impressed. I don't know how that's adjusted for Eaton Vance or E-Trade, but maybe I'm impressed by that plus 6% statistic.
Morgan Stanley, the stock is down by just 0.4% of the pre-market. Mentioned Goldman down by 1.9%. Goldman reporting about 15 minutes ago. Can we go there, Shanali? Just take stock of everything we've heard over the last week, from Friday into Tuesday. All the big names have reported now. How defensive are they set up going into the rest of 23?
All of these banks are playing offense here. Remember, we're not going to see full numbers right away in terms of the breakdown, in terms of risk being taken on by each of these banks, but you saw value at risk rise over at JP Morgan, and you're seeing that with pressure on the trading desks here. So to the extent that institutional businesses can give you some money into a tough market, questions. I think also interestingly here, if you look at our numbers for Morgan Stanley, net interest income is slightly below expectations. They have a wealthier client base by mix here. So how much net interest income can you see them boosting from their asset and wealth management this year?
Shanali, thank you. Great work. Do you take the rest of the year off now? See you in the second quarter, something like that? TK, after breaking down all the banks in the last couple of days, you always complain about the banks. I do too. I hate the way they report all at once. All at once in the morning.
Yeah, I
wish
think
they
it's
just,
manipulated.
take it easy,
Yeah.
do what tech does. Do it after the close.
I agree. I do agree, but I will say that their clarity of presentation, I was a huge critic 5, 6, 7, 8 years ago.
You've upgraded them.
No, I think they've really listened. They're like in English. I mean, anybody can look at this, whatever their sophistication, and get a feeling for the distinctions between the two.
When you say they've listened to you?
No, they don't care. They listen to Shanali.
Oh, they listen to Shanali and the feedback.
All I can say when time
Shanali's a power on LinkedIn. I mean, she publishes for LinkedIn.
Weekly.
And Global Wall Street
Weekly.
stops.
Are you on the distribution?
I am on the. I never read it, but I'm on the distribution.
I get it in my
list.
inbox.
You read it. I see who picks up.
Do you want to promote?
Oh, you do? You don't? You see that I ignore you?
I'm taking score.
Would you like to promote your newsletter?
People should read it. It definitely goes in the inbox straight to everybody. But listen, the one thing I would say, when times are good, no one's hiding behind each other as far as reporting on the same day. When times are tougher is when you see everybody come out in chorus and tell you, hey, things are bad in this business.
We've gotten such good help over the years from Kenneth Leon. Ken Leon is Equity Research Director at CFRA, and we're thrilled that he could join us right now. Ken, the mystery to me is the duration of these challenges, particularly as James Gorman and his team break out equity, what I'm going to call underperformance collegially. SPACs blew up. I don't think SPACs are coming back. How far out is the equity weakness that we see in the different banks?
Well, I don't think anyone's going to make a bet on the first quarter, but equity will come back. The market will look maybe to the second half, but there's a lot of more here in terms of Morgan Stanley versus Goldman Sachs on who has the right strategy, who builds longer-term shareholder value. And we think it's Morgan Stanley. I think Goldman and David Solomon are under big pressure. They got Investor Day 4 weeks ahead. And the question then is, who does Goldman want to be? Because they're certainly not going to be a consumer bank. They had $1.7 billion operating loss in their platform news segment, including consumer. And if they're going into private equity or asset management, they're going to have to make an acquisition.
I look, Ken, at the acquisition. Great. We talked about this before. Do they grow it organically, or do they look at an acquisition a la Eaton Vance? Is it out there? Is it active? Or is it an index manager?
Scale really matters. And again, James Gorman at Morgan Stanley, he not only got Eaton Vance, but he also got E-Trade, which put him in the top 2 or 3 in workforce 401k against Fidelity. Goldman spent way too much time in consumer bank, and they can get there in getting to. Goldman always wants to be top 3 in league tables, and to do that in private equity or asset management, they're going to have to look beyond organic. That puts a lot of pressure on David Solomon to drive shareholder value. No one really cares about fixed income trading in the fourth quarter, and the market never gives you a higher multiple for trading. And then you're left with an agent business as the best investment banker, but you're still not going to get the multiple of a BlackRock or a Charles Schwab.
John, let's call it the Leon urgency right now. I'm looking back to the great financial crisis, and Morgan Stanley and Goldman Sachs really intertwined. Something happened at the bottom of the pandemic. Goldman Sachs up 165%. Morgan Stanley up 243%. The Gorman Delta.
So, Ken, let's talk about valuations. Relatively speaking, it appears to me that you think Morgan Stanley should have a premium over Goldman. That's the relative story. Can you talk about the absolute story for the whole sector, going into what people anticipate will be an economic downturn potentially this year? Ken, how do you think they should be valued?
So we at CFRA think financials could outperform this year and outperform the S&P 500. Also, there's other areas of the financial sector like insurance that did well last year. You need the banks. You need both the large and the regional banks to outperform. And if we have a Goldilocks economy with net interest income rising and stable loans, that's pretty good. When you get to investment banks, you need a risk-on versus a risk-off environment. And to my point before, we're not going to be there in the first quarter, but all of a sudden, those stocks can take off, but we just don't see it near term.
So, Ken, there's two ways of explaining this. One is that a call on the economy, that you avoid the economic downturn. The other is a call on the quality of the institutions, the defensive nature, perhaps, of some of those names over the last 10 years. Ken, do you subscribe to that theory that these names are higher quality, more defensive, less cyclical almost for some of them?
They are. So even if we were sitting here in 2010, 15, or 2019, the banks are in a great position, but we can tend to bend over to the more traditional banks of JP Morgan, Chase, and also Bank of America. And we still think it's a little bit too early on Morgan Stanley and Goldman Sachs. I really want to hear what their strategy is, because that's the only way that they're going to drive shareholder value.
Ken, thank you. Ken Leon there of CFRA. And Ken, thanks for everything over the last couple of days as well. With us on Friday, breaking down the bank numbers. Schneider, just briefly, what time are the calls? Goldman, Morgan Stanley. When should we be following the headlines from them?
From 8:30 onward, keep following it. I would also say whatever they say about headcount and compensation will be important. You are seeing headcount up 10% over at Goldman ahead of those cuts. You are also seeing Morgan Stanley saying compensation is decreasing despite higher headcount. So,
wow. Okay, so you've got
more
Goldman
people, less money.
headcount up 10% just before they're about to cut. By what, 10%?
7. So net, your headcount is still rising on Wall Street. You're just getting paid less for it.
What do you make of that, Tom? Just those numbers on hiring, on the labor force, Morgan Stanley, Goldman.
My answers go, of all this, of the last 3-4 days of banking ballet, everybody's got a plan, everybody's moving forward, Moynihan, all the rest of them. Goldman Sachs is at a different point, and I'm with Mr. Leon that the urgency here, I've said that. I don't think anybody's surprised that I'm saying this.
Schneider, brilliant work over the last couple of days. Thank you. We'll catch up with you in the 9 o'clock hour a little bit later this morning off the back of these numbers. Goldman right now down by about 2.3% in the pre-market. We have a plan for the next hour. Neil Dutter, the head of US economic research at Renmac, Renaissance Macro Research, is going to join us. Is that in the studio, Tom? I hope it is.
I hope so.
Neil Dutter coming up in about 50
nearby
minutes.
here. He was going to come to Davos to see us, but he said if you're in New York, I'll come to New York.
He was there in New York.
Yeah.
Did he miss the flight too?
He missed the flight.
He missed the flight.
Yeah.
That's what happened when you ordered that extra round at Newark. No, that's what happens. Flights get missed. This is what happens, Tom.
Yeah, it happens, and they tried to get me there. They gave me the car from one plane. You come down the plane.
Oh, like
and
the
you
fancy
take a little
service?
car.
The fancy service, yeah.
Even with that, I couldn't make it.
Couldn't get there?
Well, I travel with 6 suitcases, so that was
You
the
have
problem.
those metal ones with stickers on. I've seen it.
Yeah.
What a scene.
The luggage was
Got
just
to update
too
you,
much.
Tom, to something a little bit lighter.
I cut back. I used to take 7-8 suitcases to Davos, and the walk up the mountain from the train station is so bad.
Was anything in them, or did you just like to be
No, I take them to bring swag back and, things for
like
vet
free
bill and
stuff.
Free stuff.
Goodie bags.
The free stuff's great. The box of chocolates that you get is, Dr. Schwab sends you a box of chocolates.
Yeah.
Pretty good.
I remember the Bloomberg Davos chocolate. That was pretty good.
Yes,
Those special bars we'd
Those
make
are
up.
milk chocolate. Yes.
Nice. Okay. Neil's coming up in about 50 minutes. Look out for that. Equity futures right now down about 0.2%. And I heard a rumour that maybe we'll catch up with Bramo next. There's been a Lisa sighting, Tom.
Oh, it's okay. Let me do the check. She's up at the crack of 2 p.m. Wonderful.
Good for her. Yeah. From New York. This is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. Russia wants to boost the size of its military to 1.5 million personnel and create new command areas near Europe. The Kremlin says that's in response to what it calls a proxy war being fought by the US and its allies in Ukraine. Russia's military currently has a target level of more than 1.1 million personnel. For the first time in 6 decades, China's population is shrinking. It's the latest latest milestone in a worsening demographic crisis for the world's second largest economy. Government data says that at the end of last year, China had over 1.4 billion people. That's 850,000 fewer than the year before. The number of births was the lowest since at least 1950. A new report says that international trade will grow more slowly than the global economy over the next decade. According to the Boston Consultancy Group, the war in Ukraine will reshape strategic alliances and alter the flow of cross-border commerce. The report forecasts that trade will grow at an average of 2.3% through 2031. Emerson Electric has gone public with its pursuit of National Instruments. It's revealed a roughly $7 billion bid to take over the maker of measurement systems. Emerson made a cash offer of $53 a share in November. Now that's an improvement over a proposal of $48 it made back in May. Emerson says National Instruments has refused to work it over the past 8 months. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question. Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions.
Inflation will eventually come down, maybe just to 2.5%, not to 2%, but interest rates are not going to come down to the same level as they were before. They're not going to come down to the same level as we saw. I wouldn't be surprised to have, say, a Fed funds rate of 3.5 quite a while from now.
Ken Rogoff there, the Harvard professor and former IMF chief economist, sitting down with Bloomberg's Lisa Abramowitz a little bit earlier. We're going to catch up with Bramo in just a second. Equity futures right now are negative by about 1/3 on the S&P 500. Softer, lighter negative to kick off the trading week. For those of you who enjoyed a long weekend stateside, welcome back. In the bond market, yields are higher, Tom, by 4 basis points. Your 10-year 354.76, and crude, there it is, TK, sticking with an 80 handle on WTI.
To me, it's the unspoken story. You've singled out the stock market move, John, that we see the VIX 20.15, and I'm sorry, West Texas now nicely above 80, and Brent crude rounded up with a vector up $86 a barrel, and Brent crude oil is moving.
We got some China data overnight, and to be honest with you, Tom, I think that data could have said absolutely anything, and this market and investors would have looked right the way through it, looked past it and said things are going to get better by the end of the year.
It's the will of the government. Enda Curran talked about that, the pressures that President Xi in Beijing are under, and he made very clear, both on-air folks and off-air, that, Enda talking about Hong Kong opening. I've got some family conversations over there talking about back to normal. Are they at normal? I'm not sure. We don't have that knowledge, but we can say within the heartache of COVID, real issues with their old people, unvaccinated, there is an effort to get back to normal.
That's the message they want to sell in Davos, Switzerland this morning, that's for sure. We heard from the Vice Premier a little bit earlier who said China is back to normal. Tom, you can decide whether you think it is or not, and I'm sure the people within that country will make that call for themselves.
Well, we'll have to see. I mean, think one more thought here, John. On China, which is there as data dependent as we are. We've got retail sales coming up later this week, and then on to the February 1 Fed meeting. It's a different world over there, but it's no different. To me, the big number here is Japan's CPI. The Bloomberg Terminal, folks, is a 4% statistic on Japan inflation. John, that's like the Netherlands, 11, 12%.
Look, I think the BOJ decision is fascinating. What's fascinating is all 43 economists surveyed by Bloomberg, except one, expect no change.
Right.
Except market participants are really focused on what happens, and I think we get some forecasts from the BOJ as well, Tom, alongside that decision.
Right now, Lisa Abramowitz is at the meetings in the World Economic Forum in Davos, Switzerland, and joins us now after doing what you do, which is you talk to somebody with legitimate academic and engineering competence on the auto business. George Berzer is with Mercedes, and Lisa visited Mercedes to talk to the guy totally up to speed on gas, EV, and hybrid. Lisa, what did you learn?
Well, Tom, you guys were framing it really well about how people want to believe China is going to reopen, the optimism that people are looking for at Davos. And before I came here, I wanted to visit someplace on the ground that was dealing with some of these 30,000-foot issues that everyone's talking about here, supply chain disruptions, the energy crisis, and potential geopolitical risks. Read China's reopening and what that means. Someone who's dealing with that in a more concrete way, Jörg Berzer, deals with that with having to head supply chains, head production for Mercedes-Benz. Take a listen to what he had to say.
We're in the middle of one of the biggest and most important transformations of an industry. We decided 3 years ago to invest more than $1 billion in our U.S. operations. And obviously now we're scaling up electromobility production. I think we will still have interesting situation on the supply chain. The semiconductors is not over. One of our biggest but also most interesting challenges is the ramp up of electromobility. What we learned now in the last weeks, also out of China, we mastered the challenge. So this fast decision making, a lot of creativity, a lot of trust in the local team. China is a very, very important market for us. What we are really focusing on is to create the most efficient and the most resilient supply chain.
What was clear to me from the conversation with Jörg Berzer was that China is such an important market for Germany, for a lot of the world. And so, yes, a lot of the potential optimism is hinging on the reopening there, and people want to believe in that, but also that decoupling isn't happening as quickly as people think, because a lot of nations, Germany in particular, really relies on trade with China for a lot of the economic momentum.
Lisa, how has Mercedes adapted to the small issue of a war in Ukraine?
They've been really focused on diversifying their energy sources. They've got a solar plant on the ceiling. They deal with wind power. They have a whole host of batteries, old batteries, electric batteries from cars that they use to power parts of their operations. They're trying to insulate themselves that way. But this has been a huge issue, right? And that was one underpinning the conversation. Mercedes thinks that the world is going to be mostly electric with respect to EVs by 2030, and this will accelerate that. On the flip side, I was saying to him, what about all these people who are investing in fossil fuels right now and are sort of ignoring what's going on? And he said, no, this is really what's going to be there. Also, I just want to say there were robots everywhere There were little robots, there were big robots. One of them almost ran me over. And it was interesting to me how much they're investing in some of the technology to replace menial labor, basically to make things more efficient. And they said it's about 20 to 25% more efficient. And they said that all of their colleagues are doing the same thing. To me, this is really interesting, that level of investment that's going to be happening that could potentially transform certain parts of certain industrial complexes.
Hey, Lisa, you mentioned EVs. Let's talk about the elephant in the room. The news last week, 20% price cut at Tesla for some vehicles across Europe and across the United States as well. Bramo, how are the likes of Mercedes going to respond to that?
Well, they also recently announced a slight price cut over in China. There is an issue of trying to corner the market, and it's which market are you cornering? Tesla perhaps is competing with perhaps slightly different types of competitors than Mercedes, which is a luxury vehicle. But you're right, there is this price competition, and I think that what you could feel in the conversations that I had with everyone there was a bit of a test. We've never been here before with prices moving up so quickly that people are able to basically throw out their price and see whether people are willing to take it. So there's a question of whether this is a lack of demand or whether this is getting too greedy, of whether this is looking for profit margins that are too fat. And I don't know the answer to that. And I don't know that they do either, but it does seem like there still is quite a bit of demand globally for electric vehicles, or at least that's what they're putting out there.
They've had a tough time of it, that's for sure, in the last 12 months. Having a good time of it. Chevron, you're going to catch up with Mike Wirth a little bit later, Lisa, I think in about an hour from now. What's the focus of that?
I want to know about when they expect to see China's demand come online, given the fact that everyone's talking about how this is going to generate growth. We've been talking extensively, I know you and Tom talking a lot about when this causes prices of oil to rise. We're seeing a little bit of that. How much more do they see that coming down the pike? Where are they changing some of their drilling and exploration in response to geopolitical risks? Have they rejiggered some of that? And also, are they investing more in fossil fuels? Are their investors allowing that and actually rewarding them more for making investments that a couple of years ago they would have kind of shunned because of ESG concerns? I'm curious about that sea change and how they're responding to it.
Looking forward to the conversation. Lisa, great work as always, and looking forward to the week ahead with you as well. Lisa Brammett's there, the World Economic Forum in Davos, Switzerland, Tom. Mike Wirth of Chevron coming up in about an hour from now.
The engineer from Boulder, and I know it well. He was about 8 years behind me there, and all I can tell you is his biggest headache is how to compete with other big oil and how to. It's so bad, John. It's not how to deploy capital. The real focus is a type 2, how to not screw it up. It's amazingly serious about how not to buy Siberian oil fields that go wrong 12 years later.
And make some big mistakes.
Yeah,
I should
Chevron,
mention a certain British company that may have done that.
Exactly. You're way ahead of me on this. But the bottom line is all of these guys are a generation behind massive misdeployment of capital. And that's really where his head is.
And that's conditioned them. That's conditioned them, and that's why we've had the rally the last couple of years in energy, right?
Yeah.
They were bruised. They were battered off the back of over-investing.
Can I bring up something I think is really important?
You don't need my permission. What are you looking at?
You know, I mean, I went back and forth with Francine Lacroix this weekend. She has just written with Lucia Giftopoulou a brilliant story on what matters with Lawrence Fink. We're making fun of the Davos jabber. And Larry Fink, talking with Francine Lacroix, talked about what I think is his third rail right now, which is ESG is blown up. It's probably good that I'm not in Davos because my questions would be brutal on this. ESG has been run over by the war in Ukraine and by the dynamics we've seen among, and I say this somewhat in spoof, King Cole. And Larry Fink saying that ESG narrative, it's become ugly and it's become personal as people go after him.
How active do we want a passive shop to be?
Well, this is his public policy.
Isn't that an important question to ask?
I am fascinated by what the next or the new ESG looks like. I really am curious about that.
I mean, I think that
Francine killed it.
The branding now is just absolutely toxic, isn't it? Don't we just have to totally just drop
it's a toxic brew. Where'd we learn that? Bramo, we miss you.
So the inflation environment has been changing a little bit. Inflation's been very low for 25 years. Now people think inflation's coming back. How are you going to deal with that?
I think many of the tools that we've historically used to battle inflation no longer work in the same ways they used to. I think people oftentimes thought of housing as a way, or especially retail and real estate as a way to hedge against inflation. less and less possible the way we've invested in it. I think commodities similarly have been thought of as a way to hedge against inflation. There are challenges over the long term. Equities have been a hedge against inflation. We will continue to do what we have done in the past, which is build a diversified portfolio where there are many different opportunities that have the possibility of hedging against inflation, because different types of inflation have to be hedged in different ways. So if it's a very quick increase of inflation as opposed to a slow rise of inflation, is it temporary? Is it a long or persistent type of inflation? So for us, I never model myself an economist that can predict where inflation is going. And so what I need to do is build a diversified portfolio where there are different options that can fight the different types of inflation, and to pay close attention to it. And you know, fundamentally, it's done through the equity markets.
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg. I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. And what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I try and play that role.
A special Wall Street Week from the World Economic Forum in Davos, Switzerland.
This is Bloomberg Wall Street Week. I'm David Weston.
Join Bloomberg's David Weston as he engages with the foremost business, political, and cultural leaders for discussions on wealth inequality, global power dynamics, and more. Accountability, solution-driven conversations, data insight. This Friday at 6 p.m. Eastern, only on Bloomberg Television and Radio, your global business authority.
Market is kind of in a very lofty state at this point in time. You're seeing a lot of irrational trading.
The Fed focuses on the level of inflation, but we in markets, we focus on the direction of travel and saying, hey, it's going down, so maybe I should be buying stocks.
In terms of the inflation, we continue to see the Fed working and bringing it down.
U.S. inflation's now decelerating.
We're probably in for another few rate hikes. That all signals a significant slowing in demand and even also a recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. We welcome all of you. Our studios in New York on radio and television. Bramo at the meetings of the World Economic Forum in Davos. She'll be there with Michael Wirth of Chevron. Look for that here in a bit. Right now, John, we are resetting, as you mentioned earlier, for the shock of 9 days. Better than good than the gloom crowd of December 29th.
Well, what a rally, and how the narrative changes off the back of a rally, hey? I've said it a few times this morning, what a difference a rally makes. Euro Stoxx 50 before today, up almost 10% year to date. EM equities up about 8% year to date before today. Mentioned a couple of single names. Our VMH, Tom, flying by about 16 percentage points year to date. Luxury doing better than good. Copper prices, take your pick right now. High yield, credit, United States, tighter.
I like how you link copper into LVMH and luxury, and this is about the China reopening. And I would suggest the China reopening is not a brilliant score by people that predicted that or an own goal. by those that were looking against it. I would say that
China
China's about shock. It's about the total unpredictable shock that can happen.
It clearly is a massive change. And when you start to get a reopening like the one we've got in China, people will be a lot more tolerant of weak data coming out of that country. It wouldn't have mattered what the data was overnight. And the data, I'm told, was better than estimated. Whatever that means in China, when they can basically tell you whatever they want to tell you about Chinese economic data, people appreciate the idea that things are going to improve. And things are better now than they were a few months ago. And the fact that you can see call after call, not just out of China, but also in Europe.
Yes.
Goldman coming out last week and saying Europe can escape recession. Deutsche Bank into the weekend saying Germany can escape recession. That's why we're seeing this massive move that we've seen in some of the European names. That's why we're seeing some of the big moves we've seen in copper and the luxury names as well. And it's spilled over to the US, and this is what's interesting to me, Tom, that we've got high yield spreads in America.
Coming in, Bramo identified that. Yeah.
Tighter at a time where people are still talking
She's
about recession.
only worked like 2 days this year, right? I mean, she was on vacation.
She went skiing.
Traveling. And
now she's doing the work, the hard work.
The hard work, the hard lifting.
The heavy lifting.
You know.
I'm excited about that interview later this hour, Mike Worth Chevron.
Yeah, it'll be interesting to see. And well, let's go to the three stories of the morning. Let's start with Mr. Worth, and that is rounded up Brent crude, $86 a barrel, and Jeff Curry and others speaking about that. Is this the path to $100 a barrel?
WTI, $80.20. Goldman calling it a bullish concoction.
Right.
A bullish concoction. If you want the full quote, you cannot come up with a more bullish concoction for commodities. A lack of supply is apparent in every single market you look at, whether it is inventories at critical operating levels or production capacity that's being exhausted.
Japan not being discussed at Davos. This is a week for Japan to decide.
On the BOJ?
Yeah.
Do they drop yield curve control? Do they take another step?
Yeah.
What kind of policy is Governor Kuroda going to hand over to the individual that takes over from him in April?
Retail sales, let's finish with that before we move on to the data. Retail sales, to me, John, huge mystery, underplayed, and frankly, is 70% of GDP. We should really focus on that.
So hard data good, soft data bad. Survey data, the ISM data has not been pretty at all. So there's kind of a little bit of a gap opening up between what's happening and what we're told is happening. So the labour market data good, you look at payroll solid, retail sales, we'll see what that says. Then the survey data is looking ugly. ISM's sub 50, manufacturing services. Yet markets are doing well in the face of that. So something's got to give.
And the thing that I saw here, to finish this up, was Goldman Sachs, the urgency that Shonali Basak showed, where coming out of earnings season, the pressures on the Goldman Sachs management to right size and move forward are greater than I thought. I misjudged that.
So we put two things together then. Layoffs at Goldman. We've talked about that over the last few weeks.
The character.
Layoffs off elsewhere as well. Bonus pool, did you hear about the bonus pool being cut left, right, and centre? And at the same time, the research divisions of many of these banks now indicating that we can escape recession, that perhaps we can have a soft landing. So you've got corporate leadership getting defensive and conservative.
I agree
with
that.
May not materialise. And at the same time, you've got people trading this stuff who are saying perhaps it can be better.
And in earnings season forward, as we see that, as you mentioned, in the big tech companies as well. I'm going to start, John, 210 spread, negative 68 beeps.
Equity futures right now, negative 0.4%, Tom. Yields just a little bit higher. Some steepening, Tom, this morning, up 6 or 7 basis points on a 10-year, 356.98 euro dollar. Bit of strength coming through now, 108.52 on euro dollar. We heard from Mr. Philip Lane, speaking to the FT, the chief economist over at the ECB. More rate hikes still to come. The ECB's next decision is February 2nd, the day after the Fed.
Right now, we're going to recalibrate to something we don't do enough on, which is actually on allocation of portfolios, on the decision to change things. Everybody looking at that now after the death of 60/40 last year. Marta Norton is excellent at this, as CIO of Americas at Morningstar. We're thrilled she could join us this morning. Marta, is there value to rebalancing? Morningstar's lodestone is page after page of data excellence on funds to make a rebalanced decision. After the carnage of 2022, should you do more or less rebalancing?
Good morning, Tom. You know, you're raising that point of the 60/40, and no question, you know, in 2022, I think we got to see the 60/40 finally through a three-way mirror, so to speak. We can see it a little bit more clearly. We can see its strength certainly over the decade prior, where it was just ascendant, and then over the past year, we saw some of the correlation that exists within the 60/40, maybe not the protection that we would have thought. And no question that as you see big price moves, it calls to question whether you should rebalance back to target. And the real value of that, of course, is that you're taking advantage of price movement in your favor. So you're adding to the things that have sold off, you're trimming the few things potentially in your portfolio that have rallied, and it just gives you an opportunity to put valuation on your side.
What is the update on the concept of target funds? They were trotted out 10 years ago, and I'm going to give Morningstar great credit on this for not selling them to the public like most of the firms did. But there was this whole contrived thing of gaming out 10 years or gaming out 15 years of that. We had the great financial crisis and then the small matter of a pandemic. Do target funds work now for allocations to retirement?
You know, I think the general idea, and this comes back to, you know, just your broad stock bond mix, the general idea that a simplistic allocation between stocks and bonds based on, you know, kind of maybe your time horizon, that can be a really powerful tool, especially when markets are moving in your favor. But when you have surprises that challenge the fundamentals, and maybe we're seeing, you know, some sort of regime shift, when we see the pressures from inflation, the pressures from interest rates, I think it's worth remembering that there's still, you know, an importance to having a smart fundamental understanding of what you're owning and how it should be complementing and diversifying one another. Now, I think, you know, the death of 60-40 asset allocation, simplistic asset allocation, I think there's a lot of people doing victory laps around the difficulties that had in 2022. And I think it's a little early to say that it's an ineffective strategy, but no question that we have to understand that there are weaknesses to every strategy, and there's weaknesses to a simplistic approach as well.
I want to pick up on a phrase you just used, Marta, and thanks for being with us on the program. You said, think about how they complement one another. Can we do that just a little bit right now? Is there any reason to believe that the correlation between bonds and equities is going to break down and return to what I think is a little bit more intuitive for a lot more people out there?
You know, I think it's a really critical question. And when we look at time series of correlation between, you know, treasuries and equities, I think we always assume that it's baseline a negative correlation. But actually, over time, it can vary quite a bit. And I think when inflation and interest rates are the market's focus, that's when we're going to start to see a positive correlation in a negative sense. That's what we saw in 2022. I will remind everyone that we saw a lot of positive correlation over the past decade between the two, and no one was all that concerned about it because they were all moving in the right direction.
Exactly.
But I think should we start to see a recession come into the fore where that's the critical concern, that's where I think you can start to see some dispersion between how fixed income treasuries might behave and what you might expect from your equity portfolio.
It's great when they're both going up, Marta, you know that. It's good to catch up. Thanks for being with us. Marta Norton there of Morningstar. Tom, it's true what Marta just said. When equities were up and yields were lower and bonds were rallying, there weren't many complaints out there about that correlation between bonds and equities, were there?
Yeah, and I'm a huge user of Morningstar, and I think Morningstar has been misused over the years. Everybody's looking at it as a panacea, sort of like what my brain isn't working right now, but the basic idea here is it's simplistic to look at it as 5 stars or 4 stars, and the answer is it was easy there for 15 years or even longer. You could almost say. All of a sudden, as Taleb says, the gravity's back. I have very strong personal opinions about rebalancing. Nobody cares what I think about it, but the bottom line is allocation concepts now are way more serious than they were 3 years ago or 5 years ago.
I think to the point that you're both making, the 60-40 simplistic kind of focus on that thing, that it works for everyone. 60-40 is not great for everyone at different times of their life. As you know, if you and I sat down with a wealth advisor, I think they'd have different conversations with us both, Tom, based on where we are in life and what we want out of life and how much risk we want to assume and what we want to do with that portfolio.
Don't get me going, John. Where's the surveillance court?
I'm just taking little jabs. Lisa, you're not coming with me.
You know, I just... I could get in trouble here.
You don't fancy it?
I think it's marketing BS, is clear as I can make it.
How much of that, so this is an important conversation for a lot of people listening, how much of that marketing, you said BS, are we going to hear this year when asset managers are lining up trying to attract capital to go into bond funds because they believe that bonds are back?
I'm going to go Ritholtz 101 on you. If you are modeling retirement off 6-month strategy, you have a license to fail. Ritholtz 101, and Barry's correct.
Neil Dudder's going to join us in just a little bit. He joined us from Renmac. Looking forward to that conversation on why he thinks this economy is doing better than good, at least for now. This is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. In China, the economy proved more resilient than analysts forecast. Last year's GDP growth of 3% was the second slowest since the 70s. Still, data from the fourth quarter and December came in better than what economists had expected, and that's despite a COVID outbreak that suggests the worst of the slump may be over. Meanwhile, trade between China and the US is on track to break records. US government data through November suggests that imports and exports in 2022 will add up to an all-time high. The final report is out next month. Here in the UK, teachers are joining other workers who have gone on strike in their fight for higher pay. The teachers' union says members in England and Wales voted overwhelmingly in favour of industrial action. Meanwhile, nurses plan to stage another walkout next month. Tesla CEO Elon Musk will be the star witness at a jury trial that starts today in San Francisco. The issue, his infamous tweets in 2018 about a plan to take the electric car maker private. Quote, funding secured. Lawyers for shareholders argue that Musk lied in the statement and that it caused them losses from wild stock price swings. And Emerson Electric has gone public with its pursuit of National Instruments. It's revealed a roughly $7 billion bid to take over the maker of measurement systems. Emerson made a cash offer of $53 a share in November, an improvement over a proposal of $48 it made back in May. Emerson says National Instruments has refused to work with it over the past 8 months. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
Multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg. Countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Tuesday, a Bloomberg exclusive live from Berlin, where German Chancellor Olaf Scholz sits down with Bloomberg editor-in-chief John Micklethwaite. A wide-ranging conversation only on Bloomberg, your global business authority.
Falling behind. We've said this before. We need today to invest just to keep production at current levels, let alone cater for additional demand, which we see
rising by at least 10 million barrels a day by 2045.
That's the view of the OPEC Secretary General a little bit earlier this morning. Live from New York City, good morning to you. Equity futures look like this on the S&P, down 1/3% on the S&P 500, coming off the back of a 4-day winning streak on the S&P. Can that continue? Tom, very focused on crude, as am I. $80 on WTI, 85 on Brent. Here's the latest from an OPEC report. Grant Smith writing this one up for us at Bloomberg. OPEC expecting global oil supply and demand to be imbalanced in the first quarter. Is top official from OPEC saying he's, quote, cautiously optimistic on the economic outlook. The OPEC countries will need to provide an average of 28.85 million barrels a day in the first 3 months of the year, roughly 120,000 barrels a day less than it pumped last month, Tom. Just the latest numbers from that report from the Organization of Petroleum Exporting Countries.
The operative word is unched. There's a lot of unched in the report, but I see some things, John, that are not unched, and one is China growth. I believe they model in 3.1% China growth, and that is far below what we're hearing from some street observers, and I really wonder what that dynamic will be.
Well, that's the bottom line. For the year as a whole, OPEC predicting that world oil demand will increase by 2.2 million barrels a day to average 101.77 million a day, while supplies outside of the group will expand by 1.5 million barrels a day. And to your point, Tom, China clicking back in, we're going to see what kind of damage that inflicts, or rather, what kind of rally that fuels in the commodity market.
And you look at a gallon of gas in the United States, Lisa and I always click on the same one. I got $3.32. I know there's many other prices out there as well, John, and I'm sorry, I'm going to take it back to the pandemic, and up we go, $2. Remember $2 a gallon?
Oh my goodness, remember negative prices?
Remember $5 a gallon? And we're down to $3.32, which is sort of, mid-level 2021
Where are we
level.
on refilling the SPR now? With
I don't.
Clicking back in at 80.
I agree, but then I have trouble with that because I'm not an expert on it. I listen to the experts on that, and they're sort of mystified by what we did.
Let's talk to one right now about it.
We could. Let's rip up the script. We can do that with Julian Lee, Bloomberg Oil Strategist. Julian from London, and with all you, we'll get to supply and demand and all that in a moment. But you're an adult on this, an academic elite. Brief us on why the SPR discussion in America matters.
I think it matters because we've become very, very used to having this huge inventory of oil in the ground that can be called on at very short notice to meet any supply disruptions. Now, I think it's important to bear in mind that, the SPR and the size of the SPR really dates back to the 1970s, when the US was a huge importer of both crude oil and refined products. That has changed dramatically. And in order to meet the import needs of the United States now, you actually need far less oil in the Strategic Petroleum Reserve than you did 10 or 20 or even 50 years ago. So I personally think that some of this agonizing over rebuilding the SPR to historic levels is somewhat misplaced. Yes, an awful lot has been taken out of it, and some of that over time needs to be put back in again. But I don't think it's quite as urgent as perhaps some people are arguing.
I want to go back to your work at the Center for Global Energy Studies, Dr. Lee, and basic idea here is guessing supply and demand, as we just saw OPEC and OECD and IEA and all the rest of them do it. Tell me about the certitude of guessing oil demand. Can you guys actually calculate it?
I don't think anybody can really calculate it. I mean, a lot of the estimates are based off people's forecasts for economic growth and for population, and models have been developed over time that have matched the growth in gasoline demand or any sort of oil demand reasonably well. But if you then sort of start looking at these forecasts, and more importantly, looking at the revisions that are made to estimates, not even of future demand, but estimates of historic demand, we see that those agencies that care about what happened in the past are revising their demand numbers often as far back as 5 years or more. And that to me says that yes, you can get a pretty good broad picture of the direction that demand for various oil products or even total oil products is going. But pinpointing the actual number, I think, is a mug's game.
Julian, can I share this quote from Jeff Curry with you, which I'm sure you've read already, but for our audience who may not have seen this just yet, Jeff Curry, who runs commodity research over at Goldman, had this to say at a presentation: "You cannot come up with a more bullish concoction for commodities. Lack of supply is apparent in every single market you look at, whether it is inventories at critical operating levels or production capacity exhausted." I think there's been some pushback this morning, Julian, over this line. Lack of supply is apparent in every single market you look at. Is that true of crude?
I don't think it is. I mean, I think we've got, there's certainly a spare capacity for production within the OPEC countries. Saudi Arabia certainly has spare capacity. The United Arab Emirates certainly has spare production capacity. Nigeria, which has been languishing for much of 2022, started to successfully increase its production in December, getting to grips with some of the issues that have kept a proportion of its supply off the market. So there is a degree of spare capacity there. What I think is concerning people about oil supply in 2023 is what's going to happen to Russia. How big a hit is there going to be to Russian production from sanctions? There hasn't been much of one once so far, but I noticed that OPEC is forecasting that Russian production will drop by, I think it was 850,000 barrels a day this year compared with last. Others see a slightly bigger drop of 1 million barrels a day or maybe a little bit more. So there's certainly that concern. There's certainly a lot of countries in the world where perhaps production looks a little bit fragile given political situations. Libya is perhaps a case in point. And there is this long-running, and this is really a long-running underlying problem that people keep highlighting about a lack of investment in new capacity. That has been, I think, hidden for a number of years by the US shale boom. But if you strip that out, the investment in sort of conventional oil fields has been low for years. And OPEC keeps arguing that this is a problem, and they're not wrong. But that investment does trickle through, and the places with the cheapest reserves to develop are largely the OPEC countries themselves.
Julian Lee, thank you, sir. This was fantastic. Julian Lee there of Bloomberg, weighing in on the commodity story off the back of the latest OPEC report, and a pretty bullish outlook coming from Goldman Sachs. Here's the outlook for the next hour on Bloomberg TV. Coming up on the Open, Gershon Distenfeld of AllianceBernstein, Troy Gajewski of FS Investments, Stephen Chubak of Wolf Research on the latest bank earnings, and Chanel Desai of Franklin Templeton. I've got to say, Chanel Desai, Tom, is pretty punchy about the idea we're getting way too comfortable with this call that inflation declines quicker than people are anticipating.
And where to, and Professor Rogoff touched on this as well with Lisa Abramowitz in Davos, is like, where are we heading towards? And the idea that we're going to 2, and even a quiescence of 3, I think is possibly off the mark. I just want to point out that the most expensive glass of wine I've ever held in my hands in my life
Skybridge
was Troy Gajewski
at the Skybridge party.
At the Skybridge wine party. And I
what was it? Do you remember what it was?
It was red. I mean, it wasn't Boone's Farm. You're
not a wine man.
Oh, I'm not
clearly.
a wine man. Oh no. When you're weaned on Utica Club and Jenny beer, you're not a wine connoisseur. But Troy Gajewski, you bring it up with him, he absolutely nails the fancy, and he can sit there and do the whole, on radio I'm doing the sniffy thing.
You still haven't bought me a Jenny Cream out.
Oh, it's a rare breed. I mean, you have to.
I'm off the drink this year.
Oh, are you?
Yeah, totally.
So am I.
Totally, I'm done. You along for the ride?
Yeah,
okay.
More or less.
Just helps with the aging process, apparently, Tom.
Yeah,
live longer, all that stuff.
I'm pickled.
I started, I had no idea it was going to turn into this, just a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg Surveillance, our studios in New York. Good morning, Lisa Bramlett with the World Economic Forum in Davos. We'll get to her here in a bit. John Farrell getting ready for the 9 a.m. hour. That is a good and beautiful thing. And right now, it's a tertiary statistic, but right now, we're so desperate, we're looking at everything we can. It's going to be most interesting to see from Buffalo, New York, the Empire Manufacturing Index. We really never covered this. And then McKee said, shut up and cover it. Good morning.
In this case, I think we may have a bit of a reaction on Wall Street because it's an absolute collapse in the manufacturing index for New York. It falls to negative 32.9 from negative 11.2. That is the lowest since the depths of the pandemic, and it is the second lowest in history for this index, which goes back to about 2000, 2001. New orders fall from negative 3.6 to negative 31.1. And employment falls from 14 to 2.8. So very bad news on the production side. The only good news you could see in this report is that prices paid also plunge from 50.5 to 33.0. So maybe what you're seeing here is the result of the Fed and its tightening policies, and you could spin this as good news. Come on, Mike. I see your next guest laughing at me over there. But if you're looking for a story, it could either be things look terrible for New York manufacturing or things look better for inflation overall.
The Broncos probably wish they were in Buffalo the weekend of December, week 11 or whatever, when the Bills, I think, had to move their game to Detroit because it was so cold. You can't tell me this isn't weather adjusted for 30 days after the cold Western New York and frankly all of New York. Remember that, Mike?
Yeah.
Were you here for that, or were you?
But this is a January number, and that was a
so
December.
This doesn't include the
This does
cold.
not include that big snowstorm in Buffalo. However, we should mention, you were right, this is considered something of a tertiary index, and it doesn't necessarily follow through to other regional PMI indexes. However, it is something on this Tuesday morning that gets your attention. It's the only number out today, so it does get somebody's attention.
20 seconds, retail sales coming up on Thursday. Your look at it.
Well, we're expecting a drop in retail
Control
sales.
group and all that comes down.
And all that comes down, which you would normally expect in January, although it's seasonally adjusted. But it does look like maybe Americans pulled back somewhat.
But it's not inflation adjusted. So if inflation comes down, retail sales come down, right? That's a theory?
That's a theory. And inflation's come down, but not all that much. You know, we're still on a year-over-year basis, still fairly high. And in the last couple of CPIs, apparel prices have gone up.
Okay, Michael McKee, thank you so much. It'll be an eventful week as we go to PPI and retail sales here. I believe that's tomorrow as well. Right now, for Global Wall Street, this is the important conversation for those pushing against the gloom crew. Neil Dutta has absolutely nailed the inability to go to recession, and certainly nailed the market reaction to better than good news with China opening and with a more resilient American economy. With Renaissance Macro, the optimists hang on every word. What is the distinction of your optimism right now? What is the thing that you would describe as the Dada optimism?
Well, I think it's the composition of growth that's improving. I was going to say, you know, Mike, one reason why the Empire number is coming in, maybe they surveyed people before the Giants win against the Vikings. I mean, that could be what's going on. But you know, Tom, I think the composition of growth is improving, right? So even though inflation is moderating, real economic growth is accelerating, and I think that combination of growth is the sort of challenge for markets to kind of deal with.
Let's dovetail your comments with Ken Rogoff, with Lisa Bramwitz in Davos. And this is the idea of disinflation. And even if we're having this parlor game of where it moves, you put out a blistering chart, I'll say 8 days ago, that said, wait a minute, if you get disinflation and incomes do okay, real incomes can stabilize, or dare I say, inflation-adjusted incomes could actually go up?
Well, they're accelerating right now. Real incomes net of transfer payments are accelerating. I mean, that's not even a debatable point. You know, as an example, in December, we know that aggregate wages and salaries probably rose around 2 to 3/10, and we know that headline inflation fell. So that means that real incomes rose. And then you have to basically make the assumption, what do people go out and do with the newfound income? And, you know, my sense is that they probably spend it. Financial conditions have been easing. I don't think you can really make much of a case right now that people are going to just spontaneously increase their rates of savings. So that should keep a, you know, firm underbelly to consumer spending. And we know that housing is now picking up again. So.
At Davos, I wouldn't do algebra, but since we're in New York, we're going to go algebra Tuesday here. Y equals C plus I plus G plus NX. And all of a sudden, to me, NX is a constructive mystery with China reopening. Does China reopening and export-import dynamics of America, does that give you more Dada optimism that we could avoid a recession?
Sure. I mean, back in, I think, 2015, then Vice Chair Stanley Fischer did a seminal speech on the impact of dollars on inflation and growth. Remember, at the time, the dollar was strengthening, the Fed was backing off. But now it's kind of working in reverse. And if you look at the broad dollar index, it's off about 10%, I think, since September. And, you know, the dollar has a very mechanical impact on the Fed's kind of workhorse models. And the fact that the dollar is declining, I think that boosts real exports, maybe 3 to 4% in real terms, and it introduces some upside to core inflation over the next year. So I think the dollar selling off is a sign that global growth expectations are improving, and I think it's an unambiguous positive for the
What is your 2023 GDP number for the United States?
I'll tell you what, it's not, Tom.
It's
not 0.5%. I think that it'll, I think something slightly above potential is plausible. Maybe 2. I mean, I think underlying growth right now is around 2.5.
I'll drag McKee into this right now. Help me here with the dots. I mean, help me here with the dispersion of the dots. Are any dots as optimistic as Dada? Is there a Dada dot on the dots?
There's not a Dada dot on the dots right now, which sounds silly to say, rubber baby buggy bumpers. But what you've got going is a situation, and Neil and I actually argued this out on the Bloomberg message system the other day. The Fed makes its forecasts. They make 19 forecasts, and we arbitrarily pick the median and say that's the Fed forecast, and it's made once every 3 months. And Wall Street changes its mind about what growth and unemployment and interest rates are going to be every day, every 5 minutes. And so to go back and say the Fed is wrong by saying 0.5 percentage point growth in December, that's not really fair. The Fed starts to change its mind as well, and they will have a new forecast in March. But even at this upcoming meeting, I suspect you're going to hear Jay Powell say that growth forecasts are rising. And we heard Pat Harker, the Philadelphia Fed president, the other day say he's marked his up to 1% for the year.
Right, but they're taking down let's assume that that's right. They're taking up their growth forecasts as we go into the March FOMC meeting and in February. But at the same time, the market odds of a 25 basis point move are also solidifying. So the idea that they're going to go another 50, that's going down even as they're raising their growth forecast. But look at Bloomberg, though. Look at your own Bloomberg consensus.
I don't know how to do that.
ECFC go.
You learn something every day, Tom.
Q1 real GDP, Q over Q, 0.1% change annualized, 0.1%. Q2 coming in at minus 0.6. These are very, very depressed forecasts and this is the consensus, so the one that updates quite frequently. So I think that's dramatically offsides, considering we're going into the year something close to 3, maybe if you trust the Atlanta Fed, 4%. So I think the consensus has a lot of work to do in kind of adjusting their expectations.
Okay, well, in search of it, where is the dot out there? When are we going to see not just a single dot, but go plural, get dots out there from the Fed? When do they migrate? How many meetings out do they migrate where the dispersion lifts up? And there's some real optimism about 1 or 2, even 3, dare I say, 3% GDP.
To me, the dots, the risk with the dots right now is that the cuts that are currently baked into the 2024 outlook get priced out because growth is coming in a lot stronger than expected. So if the Fed, all of these are sort of premised on your assumptions around unemployment and so forth. If the Fed expects the unemployment rate to go up a full percentage point from where it is right now, and if growth is coming in slightly above potential, as I expect, that means that there's room for the unemployment rate to fall. And if the unemployment rate remains low, then the likelihood of them cutting in 2024, I think that goes away. So that, to me, is the risk with the dots.
I can tell you when it happens, Thomas. March 22nd is the Fed meeting at which they will have a new summary of economic projections.
We'll observe dots.
And dots at that point.
Help me with retail sales here. Mike was setting us up for it with his grim empire number. You know where I am on this now. I'm like, yeah, okay, whatever. But the answer is retail sales matter, 70% of the economy. Sure. Inflation coming in, it's going to be dampened. So how do you interpret retail sales with the dynamic of disinflation?
There's some fluky seasonals. I think if I'm not mistaken, I think December of 2021 was a really weird month. We had a big decline in core retail sales that month, and I think there might be some seasonal adjustment issues that are going on, following the pandemic that kind of depress the numbers like retail sales in December, and we probably make that up in seasonally adjusted terms sometime in the spring. What I can tell you is that it looks like the inventory adjustment is largely over, and so I think that could be one reason why prices in things like apparel aren't really collapsing as much as.
Well, this is really important. I'm glad you bring this up. Dana Telsey's been lights out the last time with the Telsey Advisory Group folks on retail. I sort of knew that was going to happen, Mike, but school us on inventories, which is this obscure thing nobody really understands. Don't give me LIFO, FIFO, but are you surprised, like Mr. Dutta mentions here, that we cleared inventories, it seems, really rapidly?
I don't know if I'm surprised, because there's no point to a business holding on to inventories it's not going to sell. So if you go to TJ Maxx or Marshalls or something like that, you'll see some of that inventory, and it will be marked down because people are just trying to get rid of it, because you get new stuff coming in all the time. But also in the retail sales report, we saw in December gasoline prices continue to fall, so that'll take some off of retail sales. Autos they fell, auto sales, they were not as high, but it's a difficult one to translate into the retail sales report.
This is so important, Mike, that we've got people, bring the camera over here, and they're talking on the internet about your socks right now, and the symbolism, these are extraordinary socks, folks. I could never be caught dead using those. What is the economic, are those optimistic socks? Is that what those are?
Well, if it's a donut, it reflects the donut on headline inflation.
Okay, very good. Neil Dutta there with the donut socks, giving us a signal of optimistic economic growth. What we know is Dutta speaks, futures improve, -11 out to -7. The VIX under 20, 19.97. Worth of Chevron, with Abramowitz of Bloomberg in Davos. Stay with us.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. Russia wants to boost the size of its military to 1.5 million personnel and create new commands near Europe. The Kremlin says that's in response to what it calls a proxy war being fought by the US and its allies in Ukraine. Russia's military currently has a target level of more than 1.1 million personnel. In Venezuela, public sector workers mounted the biggest anti-government protests in years. Workers organized organized at least 50 protests yesterday in Caracas. Teachers were joined by nurses, pensioners, and others demanding more money from the government. They have been falling behind in an economy that has embraced the US dollar. A new report says that international trade will grow more slowly than the global economy over the next decade. According to the Boston Consultancy Group, the war in Ukraine will reshape strategic alliances and alter the flow of cross-border commerce. The report forecasts that trade will grow at an average 2.3% through 2031. For the first time in 6 decades, China's population is shrinking. It's the latest milestone in a worsening demographic crisis for the world's second largest economy. Government data says that at the end of last year, China has over 1.4 billion people. That's 850,000 fewer than the year before. The number of births was the lowest since at least 1950. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
Humanity consumes 500 billion cups of coffee every year. That's almost double what we consumed a decade ago. And yet, coffee production is one of the most antiquated industries in all of agriculture. Climate pressures like drought, heat, and blight are affecting food producers in different ways all over the world, as climate change becomes something we can taste. In the past year, hundreds of thousands of acres of coffee plantations were wiped out. What's at stake are the livelihoods of around 125 million people. Because, if you're being honest, this is a plant that cannot hold on much longer in a changing climate.
To the world of business. Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg.
Bloomberg Surveillance, and we say welcome to all of you from our studios in New York. Tom Keene, John Farrow to be with you in the next hour as well. Futures advanced -11 out to -8. The VIX has come in a little bit better. I'm going to say quiescent tape within the churn of Tuesday, looking to retail sales as being the key economic number of the day. Let's get right to it. Lisa Bramowitz in Davos, and what Lisa doesn't know is the way you run an oil company is to be sure that you study the mathematics of the legendary Ruth Rebecca Struick at the University of Colorado. I can't tell you, Lisa, how my life changed in Colorado engineering under the hard wooden ruler of Ruth Rebecca Struick. And I know Mike Wirth survived the mathematics of Colorado as well.
Well, from the hard roll that you experienced to the Davos Alps, and what we're talking about here with Mike Wirth of Chevron are a host of geopolitical issues that are coming together with oil front and center. Mike Wirth, CEO of Chevron, so happy to have you with us. But I want to start there. Everyone here is talking about China, the reopening, how much it's going to juice the global economy. When is it going to affect commodity prices in the way people have been predicting?
It could be coming, Lisa. I've met with some people from China even today, and what they tell me is the pandemic has largely moved through the big cities. People are back at work. The economy is beginning to move forward. We're not really seeing it in commodity markets yet, but the absence of that demand is one of the reasons why we've seen prices soften, and the return of that demand is what could start to firm them up again.
Although some people say that China is getting all of their supplies geared up from Australia, from coal, from all sorts of different supplies. They have huge stockpiles that they're going to unleash to dampen any kind of sudden surge in demand. Do you agree with that assessment?
Well, the data out of certain parts of the world is a little bit harder to interpret than others, and China sometimes
That's diplomatic.
is a little bit difficult to see in the short term what's happening. But clearly, in the longer term, we can see that oil demand out of China has been down here during the pandemic, and they will use coal, they'll use liquefied natural gas, but they'll use oil as well. And as their economy does return to full strength, I think we will see it in demand in a world that's pretty tight right now. And so I think that's the case for some upside in commodity prices this year, is a strong return of the Chinese economy.
How much upside could that be?
It's really hard to say. We try not to predict prices because you're always wrong. What I will say is that supply and demand are fairly finely balanced. And post the pandemic, as economies have opened, supply has been struggling to keep up, which is why even before the war began, we saw some strength in prices. And we have markets now that are constrained by rules on who can sell to which countries can buy from other countries, what prices things can transact at. So shipping legs are longer than they were before. There's a lot of strain on these markets, and it wouldn't take a big surge from China to really start to push against some of those constraints.
Because of some of those concerns and some of the frictions that you're talking about, have you changed where you do some of your production, where you focus some of Chevron's drilling and exploration?
We really haven't. Those are long-term decisions that we make based on a long-term view on supply, demand, technology. In the short term, we need to be nimble with logistics, with the way that we manage supply relationships with our customers in order to try to be sure that we meet our obligations. So there's a lot of commercial activity and logistics activity to respond to the kinds of things that we're talking about. But the long-term decisions are made on the fundamentals of the geology, the markets, and a long-term view of those things.
Do investors reward you more for investing in production in a way that they hadn't a couple of years ago, simply because of suddenly this renewed focus on fossil fuels after they've been left for dead?
Certainly our sector for the last decade has not performed like the rest of the market. And some of that was, I think, a lack of capital discipline by companies in our sector. Some of it was the narrative that oil and gas were going away sooner than they likely will. And we certainly saw last year the sector performed very strongly. And I do think that investors have reacquainted themselves with the fundamentals of the energy business, with the cash that companies generate in this sector. We've by the end of the third quarter last year, had generated record cash in our business. And so there's more capital discipline. I think the demand is there. And I do think the market is beginning to come back to us. But what I'll say is, earnings in our sector through 3 quarters of 2022 represented 10% of S&P 500 earnings. By market capitalization, it's only 5% of the S&P 500. So I think there's still upside.
Earlier last year, the Biden administration came out and said, we're going to lower prices as gasoline prices surged. We're going to do these releases from the Strategic Petroleum Reserve. Do you think that was a good policy?
I think it certainly provided oil supply to a world that was concerned about the reliability of oil supply. The reserve wasn't really set up for price excursions. It was set up for true supply outages, which we didn't experience last year. So the risk in having used the supplies the way they've been used is if we were to run into something that is more serious in terms of the availability of supply, there's not as much dry powder left as there has been for the last several decades. So it's run things lower. I think it did have a bit of a calming effect on markets, but it's left us in a little bit more of a delicate situation.
And now they're saying that they're going to potentially repurchase at around $70. Perhaps they've missed that, but they might start refilling it come February. Is this the role of the government? I mean, to sort of set a floor? Is that basically what they've done?
It's very interesting, the amount of intervention we've seen governments engage into markets that historically they really have allowed to function on market fundamentals. My personal view is that a price that the government says will refill the SPR at this price doesn't change investment decisions for our company. If we want to sell our barrels in the future at a certain price, we can go to financial markets and do that today. So these kinds of things won't change the way that we invest. I can't speak for other companies in our industry.
Do you think that this could potentially affect pricing next year if there is a push to refill, or that pressure on the other side of supplies coming into the market is not there? I mean, are you expecting that to kind of change the dynamic in a way that the market isn't fully reflecting at this time?
Well, it would certainly be incremental demand in the market that would be buying the commodity, which has been selling it over the last year. My guess is, and I don't have any unique information here, is that the government will refill slowly over time, and that it won't come in a large surge, but in a more measured way that will, probably be something the market can handle.
A lot of people are talking about this renewed focus on fossil fuels and energy companies being their top bet for this year. So suddenly people are absolutely flooding back and saying, perhaps we got carried away with ESG. Have you stopped investing quite as much in some of the renewables? Are you emphasizing that even more as sort of energy security? How are you playing that given that the dynamic, the conversation has shifted?
Our strategy has been to leverage our strengths to provide lower carbon energy to a growing world. And so we're spending the same money, we're investing in the same technologies, we're working on the same kinds of projects in our new energies business, renewable fuels, hydrogen, carbon capture and storage, technologies like geothermal. Again, we take a long-term view on markets and on investment. And so I think the dialogue being reset, and I wouldn't say it's fully reset, but it had become very polarized. And what I've been arguing for is a more balanced approach that recognizes the importance of affordability, recognizes the importance of reliable supply for national security reasons, and protects the environment, and an approach both from governments and from companies that balances these out. And that's what we've certainly been trying to do.
Just lastly, I'm curious about some of the sanctions that have been put on Russian oil, and some of which are going to come online come next month, particularly around diesel in Europe. How much do you think that's been priced in? How much is that going to be an additional price shock?
Markets are certainly forward-looking. This has been telegraphed for quite some time. And so I think that the market was generally prepared. I think people anticipate it. The risk is unintended consequences, and products tend to move in smaller quantities to local markets. Not moving a steady source of supply into Europe means that supply will go to more distant markets, and Europe will have to find their supply from new markets. And so I think some of that is underway. More of it is likely to follow. So there is the risk for some disruptions.
Mike Wirth, thank you so much for being with us. Wonderful speaking with you. Tom, back to you.
Lisa, thank you so much. Greatly appreciate that this morning. Churn of the markets right now, and as we speak to Mr. Wirth, the Chevron, $86 on Brent crude, $80.43 West Texas Intermediate. I would point out over the last 10 years, Mr. Wirth, Chevron, 9% a year, Exxon, 6% a year. There seems to be a Chevron distinction. Please stay with us through the morning on radio. On television, this is Bloomberg. Good morning.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
MasterCard introduced PayPass, its first contactless payment system, in 2002, but the technology took some time to gain traction.
I would say we first invested in this many years ago. The adoption rate on this in the early part, even in markets like the UK, Canada, Australia, was fairly slow in the early part. The inflection point of when it really started to hit its stride was when it was used in the transit vertical. So what we figured is, let's get all the transit systems around the globe enabled for contactless technology. That will create muscle memory for the consumer who will like the experience in transit and will use it elsewhere.
How do you judge the revenue proposition for MasterCard?
with an innovation like that and the adoption and the pace of it?
Look, I mean, for us, we're agnostic as to whether somebody's using the chip technology or the contactless technology or, using the mag stripe, which was the old way of doing business. We earn revenues which are quite similar across both of those. The revenue potential and upside for us comes from the fact that now more spend is being done on card-based forms of payment than was being done in the past. So we're converting that cash over to electronic forms of payment, which is where the incremental revenue comes from.
If contactless payments is the current revolution sweeping the payments industry, what's the next one?
I think pay with your smile. So, biometrics.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
Live from New York City this morning. Good morning, good morning. Getting back to work on Wall Street after a long weekend. Following a 4-day winning streak on the S&P. Do we snap that today? Futures softer by 1/3 of 1%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up, Morgan Stanley wrapping up Q4 bank earnings, investors hoping for better data out of China, and Goldman Sachs bulled up on global commodities. We begin with the big issue, what a difference a rally makes.
This is a rally, no doubt.
Huge rallies to start the year.
There is a lot of optimism on demand.
Some real optimism airing in.
The outlook for the world economy, I think, is actually improving.
At the same time, yields moving lower, so bonds rallying.
The hallmarkings of a January effect.
It's that kind of bond equity rally that's the perfect storm for the US dollar.
And perhaps there's a little bit too much complacency on what central banks are going to do.
We're looking at economic data.
The US is doing great.
We're looking at earnings data.
There's been a lot of fear-mongering coming into earnings, right?
We're seeing more optimism now carried over from China.
The reopening of China, it's finally happening.
Rising tide lifts all boats.
As a result, you have to be careful, you have to place your bets.
Joining us now to discuss is AllianceBernstein's Gershon Distenfeld, Troy Gayeski of FS Investments. Gents, thanks for being with us to kick off a trading week. What a difference a quick rally makes to start a new year. And let's go there, Troy. I'm looking at European equities up almost 10% year to date. EM equities have ripped, you've seen that. Copper prices are rallying as well. And all of a sudden, Troy, we're not talking about recession, we're talking about recovery. Are we talking about the right thing?
Well, look, I mean, clearly in sustained bear markets, you have powerful bear market rallies like you've always had historically. And clearly there's reason for optimism, particularly around the fact that inflation and CPI in particular has come down, as you know, and that has opened the door for the Fed to only hike 25 basis points at the next meeting. However, in the big picture, it still looks highly likely that once we get through Q1 and Q2 and the labor market finally cracks, the probability of a U.S. recession is still relatively high. And again, in the background, as we focus on these mini cycles up and mini cycles down, the Fed is still draining their balance sheet at an aggressive pace, money supply shrinking, and it's very hard to have a sustainable bull market with money supply contracting because the liquidity that drives asset prices higher is being gradually sucked out of the U.S. economy.
In the meantime, is the pain trade still up? This was BofA this morning in their fund manager survey. The first quarter risk asset pain trade remains up. Gershon, do you agree with that?
I just think we're going to continue to have a lot of volatility in markets. What still remains through this rally is this dichotomy between what the market expects the Fed to do and what the Fed expects the Fed to do, or at least based on their current information. Clearly the market is still pricing cuts later this year, and the Fed says they're going to be resolute. And as encouraging as the CPI numbers were, the labor market is still very, very strong. I heard Bob Michel earlier talk about the Fed going to 6% or even higher. I think, I'm not calling that as a base case, but the probability of that in my mind is higher than it is that the Fed's going to start to cut rates this year. So as you get every new piece of information, I think you're going to see volatility in the markets. You're going to see, sell-offs, you're going to see rallies and continued volatility, especially in the longer end of the rate curve.
Well, let's talk about the rally that we're seeing in high-yield credit, Gershon. That's your world. I think we've tightened 60-plus basis points year to date, and there's a little bit of a gap emerging here. There's another spread. Gershon, it's the spread between what we're seeing in the soft data, the survey data, terrible, and what we're seeing take place in credit markets, great, rally on. What do you make of that?
Yeah, I think, John, we talked about this last time I was on. There's a very strong correlation between spreads and PMI. And, we're seeing that even widen more. Spreads should be widening here. So that is troubling to us. We still think that corporate fundamentals are in a very good place to start. But, if we are going into recession, that is going to increase defaults. We don't think anywhere to the levels like maybe the market is implying. But spreads at this point, I think, are fairly valued at best.
Do you think, Troy, ISMs improve or credit spreads need to widen? This is exactly what Gershon and I talked about last time we spoke. Which one is it?
Yeah, credit spreads need to widen. I mean, to Brian's point, the probability of a default cycle, anything like we had in the global financial crisis or 2002, is exceptionally low, because even in the event of recession, it's going to be relatively mild. And remember, nominal GDP drives revenue, not real GDP growth. And unless inflation collapses overnight, we're still going to have positive nominal GDP. So, we've been articulating more of a 3, 4, 5% peak in default rates. But when you look across the fixed income complex now, and you compare high yield bonds to, say, agency pass-throughs, you're getting much more income per unit of credit risk in agency pass-throughs than you certainly are in high yield bonds.
Troy, can you explain what agency pass-throughs are, just for people that might not be familiar with any of that?
That's the principal financing mechanism for the U.S. housing market. And, they're implicitly and now explicitly guaranteed by the U.S. government. And so effectively, if you look over history, in 2008, that market got smoked because credit quality was so terrible and the agencies were effectively insolvent. But now you still have excellent credit quality in the housing market. And as home prices decline, obviously LTVs will go higher, but the underwriting standards have been so much tighter this time around that the risk of actual loss is exceptionally low. And so that's been more of a technical, driven by massive volatility in interest rates and QT, whereas what we're talking about with high yield is the very high probability of defaults going up and realizing some degree of losses to offset your income stream. And we just don't see that happening in agency mortgage-backed securities.
There's a theme here, though. Even in high yield, I hear the same thing, Gershon, that things are better quality this time around, that these asset classes will be more resilient to an economic turndown. Is that your view, too?
That is my view. Double Bs are the highest percent of the market they've been in a long time. And, not all defaults are created equal. So the average dollar price of a triple C today is 73 cents on the dollar. It's very different if a company that's, let's say, trading at, it's an average, trading at 60, defaults and recovers at 40. That's not pleasant, but that's very different than a surprise default. If a very high-quality company all of a sudden has trouble. So I think a lot of defaults, close to 7% defaults, the way we calculate it, are priced into the market. So I don't think this is gloom and doom. I'm not very bullish on spreads in the near term, but yields matter also. Maybe, hopefully this is not too technical, but the correlation between spreads and the change on the curve is pretty close to zero over time in the high yield market. So yields are important. It is different if, when the 10-year was at 1.5% and spreads were at 350, so you had 5%. It's different than today, where the 10-year is at 3.5% and spreads are 425. All-in yield is an important indicator, and it is on the higher side of what we've seen over the past 10 years.
It's a massive change, that's for sure, over the last couple of years. Equity futures right now down about 0.2%, going into the open about 23 minutes away. Mike McKee, the data this morning, let's call it what it was, ugly.
It certainly was. You were talking at the top of the show about whether we're talking about recovery or recession. Well, the folks in the New York manufacturing business are talking about recession, a big collapse in the New York Fed's Empire Index. Business conditions dropped to negative 32.9 from negative 11.2. That is the lowest since the peak of the pandemic drop-off, and it's the kind of numbers we saw during the great financial crisis. New orders also collapsing to negative 31.1. Employment falls, and prices paid dropped to 33 from 50.5. Now, that could be a key here. If we are talking about recession, and maybe this is the combined result of everything that the Fed has done so far, and manufacturing is going to have a bad patch, but prices come down, well, then that's what the Fed is looking for. So maybe overall, it's not that bad a report. You'll have to make your decisions. It is a tertiary report, John. It's not the most important thing, and it doesn't always carry over to other ISMs, but it is a bit of an eye-opener.
The PMIs right now, just not great, Mike, that's for sure. Mike McKee, thank you, sir. The team at Deutsche Bank thinks things are getting better, not worse. That doesn't mean things are good. That means things are getting better and not worse. There's an important distinction here, and it's true of Europe as well. Here's the line from them. They no longer expect a recession. We still expect, notwithstanding the much more shallow growth dent in the winter half, subdued recovery momentum during the year, we now expect annual GDP growth to stagnate in 2023. Now, Troy, that last line apparently is good news, that they expect annual GDP growth in Germany to stagnate in 2023, because previously they expected recession. This is the difference, Troy. You know, for markets, it's not good or bad, it's better or worse. Are things getting better and not worse?
Well, certainly in Europe, I mean, it's really remarkable how resilient their economy's been to the significant shocks, obviously tied to primarily energy, but also slowing global growth. And remember, Germany in particular has been more exposed historically to China's growth, and obviously China's slowed down. So that's undoubtedly, I would say, great news for Europe, because if Europe can avoid a recession, and you and Tom were talking about this earlier today, that means, you know, net export growth for the U.S. Could improve. And it further reduces that left tail of a more severe recession or hard landing, and increases the probability that GDP in the U.S. will either stagnate or only contract very, very mildly. So I think undoubtedly fantastic news, given all the headwinds that Europe has faced, you know, the last 6 months.
This is the problem people have got right now, Gershon. Are we pricing in recovery or recession? I guess the answer is it depends where you look.
Yeah, I think that's right. I think the markets are just have a very, very different view than the Fed. It really does depend where you look. You know, on one hand, if we're going to recession, bond yields at the longer end of the curve are still too high. Probably equity markets are too high. If we're not going to recession, then it's kind of the opposite. So again, I think as every piece of data comes in, it's gonna tell us part of the story. And I think one thing that I like that kind of bugs me when people talk about what is the Fed going to do a year from now, if they're prudent, which they are, it should be based on what the data is telling them. We'll see if we're in recession. We'll see how fast inflation comes down. You know, I'm fearful inflation is not going to come down nearly as fast as the Fed, certainly the market expects, and maybe even the Fed expects. So we're going to have to really parse every piece of information that comes in, see the entire mosaic, and markets will react accordingly.
Gershon, I know we have to make conversations efficient, but I think we shorten them down by saying if it's not a recession, this happens. If it is a recession, this happens. Are we really waiting for a group of economic nerds to sit around a table and say, yes, that was a recession, and then work out where a market should be? And the reason I ask this is because when we say recession, Gershon, what do we actually mean by that? When we describe that, are we talking about unemployment climbing 100 basis points, and that means the market outcome should be X and not Y? Which one is it?
That's a great point, Jonathan. Another thing that you hit another pet peeve of mine. People talk recession or not recession like there's this line. And, you know, if we're a little bit to the left of it, we're in recession. A little bit to the right of it, we're not in recession. You know, it's a combination of all of those things. It's a combination of where the labor markets are. It's GDP growth. There's a very big difference between, you know, slightly negative GDP growth for a couple of quarters versus, you know, a sustained multi-year, you know, deep, I won't use the word recession, but downturn. So, yeah, I think that's exactly right, Jonathan. And we have to be careful when we talk about absolutes, and we pretend like there's this line, and it's in other places in the market too. Maybe in my area, this line between investment grade and high yield, it's completely artificial. It was made up by rating agencies and insurance companies many decades ago. And the same thing here. Does it really matter if we're in the technical definition of recession? Let's look at where the overall economy is, all the moving parts of it, where markets are, and make our assessment from there.
I'm guilty of it too, and we've all got to do better when we have this conversation. Troy, final word, please.
Yeah, so it's interesting with regard to inflation, because obviously folks have been very much cheerful about the decline in CPI. But remember, 80% of the U.S. economy is services. And last we checked, in December, we hit a 40-year high in service inflation ex-shelter. And so that gets back to this point that, once inflation spreads to labor and services, it's much harder to break. And some of the joy over the Fed potentially hiking by only 25 and maybe stopping at 475 to 5, may be a little too optimistic given the fact that inflation is fully spread to labor and services right now.
We're going to continue this conversation. Troy Gershon sticking with us. A little bit later, don't miss this, Chancellor Scholz sitting down with our editor-in-chief, John Micklethwait. A little bit later today at 10:30 Eastern Time, 3:30 p.m. in London, a conversation you do not want to miss as banks start to line up. Goldman, no recession in Europe. Deutsche Bank, no recession in Germany. How bad is it going to be? I guess we'll find out. Coming up, OPEC bracing for China's big reopening.
We're already falling behind. We've said this before. We need today to invest just to keep production at current levels.
That conversation up next.
Is there still room for Abenomics to be carried out in full in the way that Shinzo Abe imagined it?
The economic situation that Prime Minister Kishida faces today is very different from the one that Abe Shinzo was faced with when he became Prime Minister 10 years ago.
Does Japan need a new policy? Is that what Kishida has to learn, or are there parts of this that he should hold on to?
I think there are probably parts that he should hold on to. I think the main challenge which Japan faces is demography. The population is declining, rapidly aging. Women are totally underused in the labor force, especially educated women. One needs to think about increasing immigration. These are issues that Abe tried to address, but a lot more needs to be done to quote-unquote revitalize Japan.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
We're already falling behind. We've said this before. We need today to invest just to keep production at current levels, let alone cater for additional demand, which we see rising by at least 10 million barrels a day by 2045.
OPEC anticipating a pickup in demand as the reopening of China continues. Goldman's Jeff Curry seeing a perfect setup for commodities, saying the following: you can't come up with a more bullish concoction for commodities. The lack of supply is apparent in every single market you look at, whether it's inventories at critical operating levels or production capacity. Manus has been leading the effort over in Davos, Switzerland on this conversation. Manus joins us right now. Manus, great to catch up with you, buddy. Just walk me through how balanced these guys think this market is right now.
Well, if you listen to Mazrui, who's the UAE oil minister, over the weekend at the Atlantic Council, he talks about a balanced market. Secretary General Haitham Al-Gaith was here this morning, his first Davos, my first Davos. Jonathan, you remember yours. much more cautious. I thought he would have been much more bullish on China. He lived in China. He knows China. That's why I put a store of value on what he's got to say. And it was a cautionary tale. Are you red, amber, or green on the global demand cycle? He says there's hints of green, but you don't get confirmation of the green shoots, which plays into that bullish Goldman call on commodities until later in the year. And that's 500,000 barrels a day for China. That's way below Pierre Andran's mega bull call in the millions. And even Goldman's, bully's prize, so to speak, in terms of China demand. Jonathan, I think it's just too early. And by the way, listening to your last conversation, are we in recession, recovery? I put it to you, Mr. Farrow. It's a reality check. It's not necessarily doom and gloom. It's a reality check of less savings, a little bit of restraint, and that doesn't lead you to a sort of Damocles decline. But China reopening is key.
A market recovery always helps, Manus. It always helps. Manus Cranny of Bloomberg over in Davos, Switzerland. Manus, as always, good to catch up. Back with us for a final thought, I'm pleased to say, Troy and Gershon. Gershon, you mentioned Bob Michael at JP Morgan. I wanted to bring you the quote from the conversation the team here at Bloomberg had with him. He said this: "The delayed and cumulative impact of all the tightening that we're seeing ultimately will bite and create a recession. It's incredibly aspirational to think we are going to get away with that." He offered a little bit more detail on this. He said the equation is inflation doesn't come down until wages do. Wages don't come down until employment rises. Unemployment doesn't rise unless we are in recession. Can you weigh in on that, Gershon?
Well, I can summarize that by just saying that financial markets and data works with a lag. And, that's the problem the Fed is in right now, and that their actions to date, remember, we're in January now. We got to only 2% on the Fed funds rate in August, and I believe 3% in September or October. And we think monetary policy works with like a 6 to 12 month lag. So we haven't really been in restrictive territory for very long. I think what Bob is saying, and I tend to agree with it, is there's been a lot of liquidity taken out of the system. We haven't seen the full effects of it yet, and we are likely to as 2023 develops. So I think financial markets need to be on alert. It's not all doom and gloom, but just because we're seeing somewhat decent numbers today, pick your measure, whatever it is, it doesn't mean that that's what we're going to see 3 to 6 months from now.
Gershon, when you say that financial markets need to be on alert, is there a specific part of financial markets that perhaps need to be on more alert than others?
No, it's probably most visible in options pricing. I'm not sure, given all the information we have, I'm not sure the level of either rates at the long end or the equity markets are that off from what we consider fair value. But I think that volatility at the tails has definitely increased, especially that left tail. And it's something that I think the market is going to have to pay attention to. And that's why my base view, more so than markets are going to rally or sell off, rates going to go here or there, is that we're going to continue to see elevated volatility, probably even more than VIX and other options indicators are implying.
Troy, do you agree?
Yeah, certainly. I mean, again, another reason to think that this might be an unsustainable bear market rally is just how much the VIX has collapsed and volatility pricing in general. I mean, if the VIX was still at 30, 35 right now and sentiment hadn't improved so dramatically like it has the last 2 weeks, you could think there'd be more legs to this. But unfortunately, defensive positioning has declined across all markets. And, the one thing we'd say, we haven't talked about earnings, but if you look at earnings so far, what you've seen is the power of a wealth management franchise at a Morgan Stanley, tribute to Andy Saperstein, Ben Heineke, and Jeremy Beal. And then the flip side is, if you look at Bank of America in particular, tremendous consumer data day to day, they were the most wildly bullish on the U.S. consumer and the U.S. economy going back 2 quarters. And that tune started to change in Q3 earnings. And now in Q4, their base case is a U.S. recession. And even though the labor market and the consumer lags, you have seen substantial deterioration in excess savings. You've seen substantial deterioration in the savings rate. Obviously, you still have 1.7 job openings per unemployed, but the trend is still down. And the labor market is really the last major economic item to crack in a downturn like we're going through.
Resilient so far. Those cracks still to be expected maybe later this year. Troy, Gershon, great to catch up with both of you. Thanks for being with us. Just there you heard Troy mentioned the earnings. This from Mike Wilson and Morgan Stanley this morning. I'm sure many of you have seen it. If you haven't, I'll share it with you now. What a quote. Bear markets are like a hall of mirrors. designed to confuse investors and take their money. Trust your fundamental process. For us, margins and earnings are likely to significantly disappoint, whether there is a recession or not. That line there, bear markets are a hall of mirrors designed to confuse investors and take their money. Is this just a bear market rally? We'll keep building on that conversation. The latest from Mike Wilson. An equity bear, at least in the near term, over at Morgan Stanley. Coming up the morning calls and later, Goldman Sachs and Morgan Stanley wrapping up big bank earnings. More on that with Stephen Chubak of Wolf. Plus, we'll catch up with Chanel Desai of Franklin Templeton. Chanel thinks people are getting a little bit too excited too soon about inflation rapidly decelerating. That conversation coming up shortly. Equity futures down by a little more than 1/10% on the S&P. No drama here. In the bond market, the curve a little bit steeper. Your 10-year high by 4 basis points. Your yield there, 354. Your 2-year, your yield lower by a basis point to about 422. From New York, this is Bloomberg.
Typically, between the time you start and they get out in the farmers' fields, is about 8 years. Now we have a pipeline of innovations. We've been funding the CG system for 20 years now. It's funded at about $1 billion a year. If people care at all about adaptation, that thing will be funded at $2 billion a year. I mean, there won't be anything close to the impact of climate-related seeds, climate-related maize, rice, wheat, sorghum, millet. And thank goodness, because of human genetics, we know how to do the editing. Thank goodness, because of AI, we know how to find the alleles. Because of drones, we can measure stuff in the field. So there's huge advance in terms of how the whole seed ecosystem moves at full speed.
When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
Four-day winning streak on the S&P 500. Does that break today? Equity futures right now. No drama here. We're down about 1/10% on the S&P, on the Nasdaq down about 1/10% also. That's the price action. Let's get you some morning calls. 3 of them. The first one from Wells Fargo. Downgrading Pfizer to equal weight, highlighting the stock's expensive valuation and growing threats to near-term margins. That stock's negative 2.4%. Next up, JMP Securities downgrading Snap to market perform, expecting weaker user engagement amid increasing competition. 973 on that name. We're down about 0.7%. And finally, Piper Sandler downgrading Bank of America to underweight, forecasting a challenging year ahead with limited visibility and weakening net interest income. We're down about 1% to 34.88. Coming up, Goldman wrapping up big bank earnings with a miss. We're breaking down the results with Wolf Stephen Chubak, who downgraded the shares just 2 weeks ago. Plus, Franklin Templeton's Chanel Desai joined us for more around the opening bout. Your opening bout just around the corner.
Okay, so you're moving in on me. Quick. Distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
The long weekend is over stateside. The opening bell about 20 seconds away. Going into it, futures just about turning positive on the S&P after a 4-day winning streak on the S&P. Believe it or not, 4 days on the S&P 500, the longest daily winning streak going back to September, following the biggest weekly gain on the S&P since early November. Futures just about positive going into that bell. The opening bell rings, switch on the board and get to the bond market. Yields looking like this. Going into retail sales later this week at 4 basis points on a 10-year, 354.39. Curve a little bit steeper this morning. Dollar a little weaker again. Going into the BOJ in the next couple of days. Euro dollar 108.63. Positive 0.4% on euro dollar. Some euro strength. A couple of names in the last week or so. First it was Goldman dropping their Eurozone recession call. Deutsche Bank dropping its German recession call. The euro stronger this morning and crude rallying. Looking at 81, having a little look at 81 after going through 80 earlier on today. $80 and about 99 cents turns to 81 right now on the screen. I waited for it at 1.4% on a session. About 40 seconds into this, equities unchanged on the S&P. On the Nasdaq, we're down about 0.1%. One sector to watch at the open, the financials once again. Goldman, Morgan Stanley, wrapping up earnings season for the big US banks. Kelly Lyons has more. Hey, Kaylee.
Hey, John. Yeah, these two stocks moving in different directions at the opening bell. Goldman down about 2.5% after its net revenue came up short of expectations. They're getting hit by the slump in deal making, plus that consumer business that lost about $2 billion in 2022. And all of that hurting the top line at the same time that costs are going up. Operating expenses jumped 11%, compensation playing a massive role in that. That rose by about 16%, and the bank upped provisions for credit losses as well. One bright spot helping to cushion that blow a bit is FICC trading, which actually jumped 44% to $2.7 billion. Interestingly, Morgan Stanley, on the other hand, which is up about 4% at the bell, missed estimates on both FICC trading and equities trading, though that equity trading revenue figure of $2.2 or so billion is still the highest on Wall Street. And the real highlight here is wealth management. Net revenue there topping estimates, bringing in about $6.6 billion, benefiting from higher net interest income as the Fed has been pushing up rates. So all of that helped revenue overall to narrowly beat estimates. It came in at about $12.7 billion. Still, though, that is down 12% year over year. So this bank has actually seen negative revenue growth in every quarter of the last year. So we'll see, John, if that starts to turn around. Obviously, the financials facing a tough picture as we talk about potentially the recession question. Recession, I say, John.
Recession. I keep hearing the same things. Kelly, thank you. As always, thank you very much. Morgan Stanley up by almost 4%. Goldman down by about 2.5%. Let's get you some commentary from the C-suite. This from David Solomon over at Goldman Sachs. Against a challenging economic backdrop, we delivered double-digit returns. Our clear near-term focus is realizing the benefits of our strategic realignment, which will strengthen our core businesses, scale our growth platforms, and improve efficiency. A lot of corporate speak, Shonali, for you to translate.
I'll translate it for you very quickly right now. That double-digit return is above expectations for the return on equity, and it sets him up to talk about it more at Investor Day at the end of February. Remember, 10%, even though it beat, it is below that medium-term goal. I do want to switch over here for a conversation about Morgan Stanley really quickly, because you did see compensation expenses also rise there, but not at every unit, and you also saw it rise less than you saw in the fourth quarter over at Goldman Sachs. It's an expense story, there's no question about it. When you hear Morgan Stanley CEO James Gorman talk about it on the call with investors right now, he's saying that, we're not really heading into a dark period. We want to feed the beast, is what he is saying, which is classic James Gorman. And so what you're saying is hearing these bank executives saying, we still need to spend, guys. Take it easy, because even though revenue is under pressure in some serious business lines, they still need to be adding headcount. They need to be taking on risk. Speaking of risk, they did get questions very specifically on how much Twitter was the reason for that more than $350 million write-down that they saw, mark-to-market write-down. They're not going to comment here on single names, but it does beg the question on what kind of dry powder it gives you for a bank like Morgan Stanley to recapture that ability to keep feeding the beast once James Gorman says that mergers and acquisitions will come back.
Shanali, let's put a bow on it. The quarter's up. What's the big takeaway for you?
We're still waiting to hear from David Solomon speak to investors. Listen, that expense line, it's something to swallow at a time where you're still delivering bonuses that will be less than some people would have wanted. You also have Mike Mayo, who's very upset about the woefully short disclosures over there at Goldman Sachs. Again, the tension that creates for you ahead of Investor Day is pretty dramatic.
Shanali, looking forward to your coverage of that in a few weeks' time. That stock's down by a little more than 2% over at Goldman. Wolf Research's Stephen Chubak downgraded Goldman and Morgan Stanley only 2 weeks ago. In anticipation of today's results, he wrote the following: Morgan Stanley and Goldman have been among our favourite stocks, but we see a number of risks emerging, given elevated market sensitivity, capital markets headwinds, and higher capital under Basel IV international banking reform. Outside of valuation, we struggle to build a strong investment case for the banks. Stephen, I'm pleased to say, joined us right now. Stephen, great to catch up, sir. So, do these numbers reinforce the position you had coming into this release?
Yeah, no, thanks so much for having me on. As it relates to our expectations coming into the release, we saw really strong activity on the trading side, investment banking activity, of course, a bit more muted. But as you guys were alluding to earlier in the discussion, it's really about expense control as it relates to Goldman, as well as higher credit costs. So thinking about it more holistically, how is that going to impact the outlook for returns? And I would say that there's been some disappointment based on the feedback that we've gotten as it relates to both the higher credit costs at Goldman, as well as the elevated expenses. And David has made it pretty clear that he's committed to their longer-term targets around ROTCE, around efficiency. And so the Investor Day is going to be critical in them demonstrating their ability to put 22 and some of the headwinds, particularly towards the back half, behind them, and demonstrate an ability to take that low double-digit return to somewhere closer to the mid-teens.
Stephen, who do you think has taken their medicine and put the bad news behind them and set up conservatively enough to perform this year?
I mean, I actually think that Goldman did a pretty good job this quarter of kitchen sinking it, for lack of a better term. Certainly feels like they built substantial reserves, did what they needed to take the pain on the severance side, on the comp side, and be able to improve the returns from here. In Morgan Stanley, I think it was more about their ability to deliver improved returns in wealth management in a relatively challenging backdrop. The big debate that's emerging is Morgan Stanley seems to suggest, the management team, that NII has not peaked. That's quite a bit different than what we've heard from some of the other big banks. And so our expectation is that funding pressures are going to continue to build. Morgan Stanley had a more optimistic tone as it relates to the NII outlook. So that was a big differentiator relative to what we heard from the big banks, certainly driving some of this strength today in terms of what we're seeing on the tickers.
So, Stephen, this raises a big question, and it's a broad one, so forgive me for asking such a broad question, but how should these names be valued?
It's tough because in a recessionary backdrop, you'd argue that we should be looking at price to tangible book multiples. And on that basis, Goldman trading somewhere between 1.2, 1.3 of tangible. If you believe they can deliver a mid-teens ROTCE, that would suggest that the valuations are relatively attractive. The big problem is the regulators are going to increase capital requirements on some of the big banks, something called Basel III Endgame. It is very complicated, but long story short, capital requirements are going to increase materially, and that has significant implications for future returns. So for Morgan Stanley, trading at 2.3 of tangible with that overhang in terms of tougher capital requirements, I would argue that the valuation here looks relatively full, what prompted us to downgrade the stock at the start of the year. And despite today's move, our view there hasn't really changed. Those risks are not adequately reflected in the stock prices today.
Steve, final question. This is an easier one. Can you and I start a petition to change the earnings calendar for the banks?
You can blame Davos. That's the excuse I heard from everyone.
Really?
That was what drove what was admittedly a much busier Friday than we would have liked, especially before the long weekend.
Not good. Stephen, thank you, sir.
I will gladly sign that petition.
I'm on board. I'll lead the way. Stephen Chubat, thank you very much, buddy. Good to catch up. Broader equity market right now, 8 or 9 minutes into this, down about 1/10% on the S&P. On the NASDAQ, we're down about 1/4%. The attention will shift from the big banks to big tech. Netflix reporting results on Thursday. Microsoft earnings only a week away. Ed Ludlow on the West Coast. Ed, you're going to be a busy boy.
I am, and I know you keep hearing this word, and you're going to hear it from me as well, recession. What's interesting about the technology sector is we're kind of not even yet pricing in an earnings recession, let alone a global economic recession. And really, when it comes to technology, that is the debate. You're right, we're down 0.3% on the NASDAQ 100, snapping 6 straight days of gains on that index, which was our longest streak going back to November of 2021. If you take the communications services subsector as an example, if there is a bright spot, it's that we're coming potentially out of this earnings trough. You know, look at the second and third quarter of 2022. The estimate for the fourth quarter, or the final 3 months of last year, is a decline of around 19% year on year for EPS growth in the communications services sector, which includes names like Netflix, like Disney, but also includes Alphabet, the parent of Google. And then things start to, I guess, improve the first quarter of this year and into the rest of the year. On aggregate, though, if you look at earnings expectations for the NASDAQ 100 for the whole year relative to the S&P 500, I think Bloomberg Intelligence forecasts will drop around 2% on EPS for the year on the NASDAQ versus a 2% gain on the S&P 500. I've been looking at the options market and kind of bracing for what's to come in the coming weeks and in terms of the share price moves. But John, I know you like to look at this. Think about this in a market cap move perspective as well. How difficult things were for Apple, for example. There's been optimism of late around Amazon that's been on a really hot streak. Well, what happens if they disappoint to the downside? We could see some big moves in the indexes based on those stocks.
Ed, excited for this one. I am. I'm looking forward to your coverage of it. Ed Ludlow there, good friend of this program. He'll lead the way on tech earnings a little bit later into this week and into next week and into early February alongside Caroline Hyde. Equities right now down about 0.2%. Franklin Templeton's Sean Desai expecting wage growth to stay high and inflation maybe to be stickier than some of you think. Markets still have a glass half full view on wage growth and inflation expectations, while various wage growth measures are showing a decelerating trend. The level of wage growth we're seeing is still not consistent with 2 to 3% inflation. Chanel, I'm pleased to say, joins us right now. And so I've got to say, great piece with Barron's over the weekend as well. Enjoyed reading it. And I think the push you're making here is important. You are not with the pack. And the pack is shifting towards this idea that inflation is going to rapidly decelerate. Why are you on the other side of that?
So I think it's a couple of things. People, there's a little bit of wishful thinking going on as far as I'm concerned, because I'm looking at a series of different factors. Number one, this economy is slowing. There's no doubt about it. Definitely, at some stage, the labor markets are going to start showing this impact. However, we're looking probably at a budget deficit of about 5% of GDP this year, in an economy which still has unemployment through full employment by a long measure. We continue to see wage growth by its broadest metrics. If you look at anything like the Atlanta Fed indicator of wages, wage growth is slowing. We're still looking at 7.7% in the last number which came out. And for people who are continuing in the same jobs they have, we're looking at wage growth for around 5.4%. I look at unit labor costs, I look at wage costs. I don't think that's consistent with inflation decelerating as quickly as I think many in the market hope. We definitely are in a different position than where we were at the start of last year, where I really felt out there by myself. But right now, I think I still feel there's a little bit too much optimism in the market. I do think that inflation is coming down. I don't think it's going to come down quickly enough for the Fed to essentially A, pause, and B, get to the second half and rapidly start cutting rates. there's a little bit of cognitive dissonance here, right, Jonathan?
Sure.
In the sense that we're not anticipating a massive recession, because if we were, what are stocks telling us right now? And on the other hand, if you're not anticipating that recession, why on earth should the Fed rapidly start cutting rates again?
It's kind of the issue that I've got as well, Chanel, at the moment too, that I see this rally in EM equities, I see this rally in European equities, I see this cyclical appetite returning, and for the very same reasons, you should be able to make the argument that yields should be higher, not lower.
Yeah.
Chanel, shouldn't yields be higher if you believe in this cyclical recovery?
Well, I do think yields should be higher. And I also think the type of moves we've seen in 10-year treasuries, periodic 20, 30, 40 basis point moves in a matter of days or weeks, I don't think we've seen the end of that, because we're still at a point where markets desperately want to essentially bludgeon the Fed into coming around to their way of thinking. So far, it doesn't look like the Fed is going to agree to do that, in which case, at some stage, the market has to move to the Fed as opposed to the Fed moving to markets.
Can I just jump in on that? This is important.
Yeah.
I see what you see, and that's a reluctance to internalize this shift in central bank behavior. There is just a belief they go back to the old playbook. Chanel, what do you think underpins that?
So I think it's actually a recency bias. I've been accused of recency bias, by the way, because I think inflation is going to stay higher than most of the markets. But I think it's a longer recent, in the sense that after the global financial crisis, the Fed has had, and central banks in general, have had one playbook, and that is, whatever happens, you throw the kitchen sink at the problem, because there was this massive fear of a second Great Depression. That happened after 2008, again after COVID, it was a Great Depression. That's the fear lurking in the back of everyone's minds. And the Fed has had the ability and the lack of constraints to throw the kitchen sink at the problem. This time around, it's not that. And I think that what has happened over the last couple of years, this notion that somehow inflation was dead, it was over, there was the famous new normal, secular stagnation, you name it. That's what was supposed to explain why we were never going to get inflation anymore. And instead, the laws of economics work. You have loose fiscal, you have loose monetary, at some stage you're going to get inflation, and inflation has come. So my sense is that central banks are not going to be hasty in pivoting back to the last 15 years playbook. They're going to take this, and for a period of time, when they cut rates, because of course they will, at some stage the Fed will cut rates, I don't see them cutting rates all the way down to 1%. I don't see QE again. And there's still this overwhelming perception that as soon as you get a slowdown in the economy, as soon as you see unemployment move up towards 4.5%, close to 5%,
yep.
Again, we're back to throw everything at the problem. You know something, 4.5% unemployment for this economy is not catastrophic.
Yeah, I heard Ken Rogoff push back against that a little bit early this morning in Davos. Chanel Desai, this was fantastic as always. It's good to catch up with you. Thank you.
Great being here. Thanks, Jonathan. Bye.
Thank you. Coming up, a debt ceiling standoff looming on Capitol Hill.
The Senate's going to have to recognize the fact that we're not going to budge until we see meaningful reform with respect to spending.
That conversation up next.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The NEC was started under President Clinton, and Bob Rubin was the first person to hold that job. Can you explain to people what it actually does and what the NEC does day to day? When, for example, who's in the NEC, who's on the NEC, what is your job actually to do?
So the National Economic Council, the job, the mandate, the mission of the organization is to coordinate economic policy across the executive branch and across the cabinet to make sure that the president is getting the benefit of when making decisions of his entire economic cabinet, and also that the economic cabinet is getting clear direction from the president as well. So that two ways. So it's a coordination function. On the NEC itself are all of the relevant cabinet members, the sort of core economic team, OMB, Council of Economic Advisors, Treasury, but also Secretary of Labor, Secretary of Commerce. My team, the NEC team, is a small team within the White House that is, our job is to do that coordination across the range of economic policy issues.
Now, you were the deputy in the Obama administration at the NEC, now you're the director. Which NEC worked better, the Obama administration one or the Biden one?
Well, on the issues that I worked on in the Obama administration, it worked very, very well. And the current NEC works very well as well.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Republicans were elected with a mandate from the American people in the midterm elections. We campaigned on the fact that we were going to be serious about spending cuts. So the Senate's going to have to recognize the fact that we're not going to budge until we see meaningful reform with respect to spending.
The battle lines are drawn in D.C. House Republicans demanding spending cuts in return for lifting the debt ceiling. Democrats urging them to focus on future spending bills instead.
If you want to debate about future spending, do we want to have defense cuts? Do we want to have spending cuts? That's a legitimate debate. I will disagree with them, but that's a debate. But you don't debate whether you pay your debts. You don't debate the prestige of the United States.
AMH down in D.C. for more. Hey, Anne-Marie.
Hey, John. Well, it's going to be a knife fight, and those are the words of Representative Gonzalez over the weekend when it comes to the debt ceiling. We're already seeing, as you call it, the battle lines already being drawn. We know that Republicans want to extract concessions from spending from the Democrats in order to raise the debt ceiling. We know that they want $130 billion cut from the budget. There's also a Washington Post exclusive reporting about the fact that they potentially are planning a payment prioritization legislation, basically saying we will raise the debt ceiling for some payments and not for others. Besides the logistics of that being difficult, the Democrats are just not going to play ball. President Biden says this will not become a, quote, political football, but already the warning signs are there. We have Treasury Secretary Janet Yellen coming out with a letter saying that marking this Thursday, there's going to have to be these accounting maneuvers in order to make sure that we can continue to pay our debt.
So Secretary Yellen's going to have a busy year, that's for sure, because this problem is not going to go away anytime soon. Maybe it's a problem for the summer, later in the summer going into fall, I've got no idea. One thing I do know is that Secretary Yellen is going to head to Switzerland, just not Davos, she's going to Zurich, to meet with the Vice Premier of China. We heard from the Vice Premier of China in Switzerland today, and there's this one line that just jumps off the page to me, Anne-Marie, which I think is almost ridiculous. China's fundamental national reality dictates that opening up to the world is a must. We oppose unilateralism and protectionism. China opposes protectionism. How is Secretary Yellen going to take that seriously?
It's a difficult question because she's not going to. This is something the United States has obviously been trying to fight, this protectionism-ness in China, this attitude that China has, especially when it comes to IP theft and what they're doing in terms of subsidies in their own country. This is something that, you know, this is just speaking to a Davos elite crowd, but it's actually not what China practices on the ground. John, honestly, I know Liho is the vice premier's in Davos right now, but the more important meeting is 100 miles away in Zurich, and everyone at Davos wants to know what comes out of this meeting because it's on the heels of President Biden meeting with Xi Jinping at the G20, and we do know that Secretary Yellen is really a proponent of this so-called friendshoring, the fact that she wants to bring supply chains away from China. Also, the United States is trying to coalesce allies to go on board with their curbs of advanced technology against China.
Yep.
And they're doing that today with the Netherlands.
And there's some tension between the Europeans, you mentioned the Dutch, some tension between the Europeans and the Americans at the same time, which maybe is a theme we should be pondering a little bit more. Anne-Marie, thank you, down in Washington. What a week still ahead. What a 24 hours for Secretary Yellen. Equities right now, basically unchanged on the S&P for some sector price action. Just quickly, here's Kaylee.
Well, John, the index is flat because the gainers are completely offsetting the decliners. The big decliners being communication services down 1%, financials down about 0.8 as well. The outperformance, though, coming from energy, that sector at more than 1% with WTI back above $81 a barrel. And just pointing it out because it's Bloomberg Crypto Day, John, a lot of crypto-related equities rallying, too, with Bitcoin in the middle of its longest winning streak since November 2013.
You got 5 seconds, promo the show. Go on.
1 p.m. Eastern, we're going to be talking regulation with the CFTC Commissioner, John.
Can't wait, Kaylee. Looking forward to it. Thank you. From New York, your trading diary. Up next.
of a push have you seen from the Kishida government in terms of green funding? The Kishida administration has committed to doubling the amount of investments in so-called green technologies. I think we need more than just pronouncements. We need real money backing very innovative startups and innovative companies in this space. What do you make of Kishida's new capitalism? Well, I think his framework is reflective of the challenges that Japan society is facing, namely that growth has been present, but growth has not been, of course, evenly distributed. But frankly speaking, it's hard to redistribute income if you don't have much income to begin with. If the government and private sector can work together and collaborate to drive more innovative growth startups, that can really drive the income growth that the Kishida government needs to redistribute.
This is Bloomberg.
Just ran the numbers quickly in the commercial break. 5-day winning streak on the S&P would be the longest winning streak on the S&P on a daily basis, going all the way back to November 2021, believe it or not. That's the price action, slightly positive. Let's get you the trading diary. John Williams of the New York Fed speaking at 3 p.m. Eastern. BOJ rate decision coming up Wednesday, plus US retail sales and PPI numbers too. Lots of Fed speak. Bostic, Harker, Logan coming up later this week. Jobless claims on Thursday. Netflix numbers on Thursday too. And closing out the week with existing home sales on Friday. From New York, that does it for me. Good to be back. Thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
there still room for Abenomics to be carried out in full in the way that Shinzo Abe imagined it?
The economic situation that Prime Minister Kishida faces today is very different from the one that Abe Shinzo was faced with when he became Prime Minister 10 years ago.
Does Japan need a new policy? Is that what Kishida has to learn, or are there parts of this that he should hold on to?
I think there are probably parts that he should hold on to. I think the main challenge which Japan faces is demography. The population is declining, rapidly aging. Women are totally underused in the labor force, especially educated women. One needs to think about increasing immigration. These are issues that Abe tried to address, but a lot more needs to be done to quote-unquote revitalize Japan.
A special Wall Street Week from the World Economic Forum in Davos, Switzerland.
This is Bloomberg Wall Street Week. I'm David Weston.
Join Bloomberg's David Weston as he engages with the foremost business, political, and cultural leaders for discussions on wealth inequality, global power dynamics, and more. Accountability, solution-driven conversations, data insight. This Friday at 6 p.m. Eastern, only on Bloomberg Television and Radio, your global business authority.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
I won! Look for the winning number in Sci-Fi stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the number fever campaign. Del Fierro thought Pepsi's number fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees. But for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue a warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack of the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained one man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Benegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Benegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Benegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Weinergold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Weinergold as an opportunity to leave that troubled home. Weinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there, like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is, when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environments, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small and, well, space is really big. And then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if they, if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities and the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't, and the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people like want to unpack that. And so my audience is, a lot of them are younger investors who are looking to hone their skills.
Tech and right up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just like attacked that video and were like, you explain things so much better than my boyfriend or my professor, or like I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly, this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwits, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, the hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350. Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa!
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit, Twitter, TikTok, and Discord to tell one another to keep buying and, quote, hold the line and not sell GameStop.
People are getting cheerleaded for jumping in, buying at the highs. They're saying, keep going.
And it was working too, until
Thursday morning, the trading app Robinhood sent out this tweet. In light of current market volatility, we are restricting transactions, including GameStop.
People were really angry.
Robinhood was supposed to allow the regular people to play the same game these big boys are playing. But instead, we were all taken for schmucks, and they screwed us.
Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stock.
But what we learned is that when people organize online, they have the ability to disrupt the market.
And it was a big sign the ivory walls of the institution aren't as powerful as maybe the institutions thought them to be. I don't know if pumping up GameStop was the best use of billions of dollars, but I think that as a signal to society, it was pretty interesting and powerful.
The GameStop saga was so impactful that both Vlad Tenev and Roaring Kitty were called in to testify before Congress to clarify each of their roles in the saga.
One thing that's emerged from the congressional hearings is that They're interested in how retail brokerages make money and whether they're keeping the best interest of their customers in mind, but it's pretty fuzzy as far as what they would actually do as a result.
While the frenzy around GameStop eventually subsided, it didn't take long for retail investors to find other areas to invest their money.
Take a look at Bitcoin going bananas over the weekend.
Bitcoin forms a brand new all-time high.
It was after GameStop started to drop that we saw Bitcoin really go up to over 60,000.
How much further does this rally have to run?
It's compelling to say that money shifted from one venue to the other.
While correlation doesn't equal causation, there's a chart out there showing an inverse correlation on meme stocks going down and cryptocurrencies going up.
There's definitely an aspect where people are making money on stocks and then moving, they're agnostic, they're not hedge funds. They can invest wherever the hell they want. It's a classic sort of momentum trade. They're going to wherever the winners are and they're willing to jump on and, ride it.
So whether it's meme stocks like GameStop, meme coins like Dogecoin, or entirely new ways to invest in art like NFTs, the new kind of retail investor is making its presence known.
Over the next 10, maybe 15 years, you're going to continue to see, whether by choice or by force, that baton go from older generations to younger generations. I don't think any single app is going to be the thing that disrupts. I think people are the disruptors.
How people get ideas about what to invest in has become increasingly entwined with social media. And as social media companies govern more and more of our lives, the fact that now they're tied in more intimately to people's wallets is something that we might want to understand better.
Usually what disruption, I think, means is technology comes in, whether it's blogs to the newspapers or online retailing to brick and mortar. They come in and they're in the same business, but they just do it in such a gigantic cost savings that it causes everybody to switch. Well, that's the risk that happens here, is that it's so much cheaper to just manage your own money. We're not there yet, but costs and conveniences are moving in that direction. So I'd say, Wall Street, you haven't been disrupted yet, but you could be in the coming years, and that the final chapter on this story hasn't been written.
Meet Bloomberg's own David Nicholson. Now, his happy place is out in the field, on the open road. But like the rest of the world lately, he's been working from home a lot more than he's used to. COVID-19 has prompted a massive urban exodus as professionals of every ilk yearn for more space to live and work. As a result, rural areas have exploded, and they're poised to experience a resurgence as more and more families pack up and leave the big city to try out life in the burbs. But there's one problem with that. Not all internet speeds are created equal. Anyone who might need to upload or download large files for a living may not want to pack up and move to that cabin in the woods just yet. Now, David's house isn't a cabin, but it is in the woods, and inexplicably, his internet is workable.
My internet is okay. I pay a lot for it. It's around $140 a month. The download speed's great, and the upload speed is terrible, which is really bad for my work because I have to upload these massive files. But I'm definitely one of the more lucky ones in this community. Just a few miles down the road, my buddy has awful internet.
It's usually under 2 down and under 0.2 up, so it's often unusable. Some days it's around 1, and other times it'll drop down to about
0.2, 0.3.
I just want to be able to have internet at my house without having to go outside the normal ways of acquiring internet. It's really frustrating.
We're literally a few miles away from downtown, and it just cuts off.
This is a problem, and the solutions are not there yet, because getting high-speed internet in rural areas en masse is something our providers may simply not be ready for.
If your internet service doesn't have fast download and upload speeds, then you don't have high-speed Harmony. You have.
Americans on average pay about $70 a month for internet at home. But in rural areas, it could cost a lot more for a lot less service.
So the pricing for a fixed wireless provider here can be something between $80 and $150 for about 25 megabits per second. However, gigabit service, which is 1,000 megabits per second and symmetrical, is running at about $119 a month or $130 a month.
That's John Paul. He co-owns Spiral Fiber, an internet service provider here in Nevada County, California. And for the past 10 years, he's been trying to bring an affordable fiber optic network to town. It all started when he applied to be part of the pilot program for Google's fiber service.
Across the country, civic boosters have been going to extremes, chanting, singing, Google in the morning, and marching, trying to get the search engine giant to look at their town.
The internet these days is crucial to be in the world, to be a part of the world, and to be connected to your community.
Google ultimately went with Kansas City, Missouri, which left Paul on a mission to get funding to lay out fiber optic networks for gigabit service. Over the next several years, he would attend conferences and pitch venture capitalists and apply for grants to make his vision come to life.
One of the biggest roadblocks to building infrastructure for the internet here in the United States are the existing large providers. They have their land staked out. They would prefer that nobody come in and compete against them. In 2013, we applied for a grant. We went down and met with the commissioners at the California Public Utilities Commission. It was an arduous process to get funded, but we finally did against all odds. We got a $16 million grant, and then we went out to seek venture capital.
Then, in March of 2020, the pandemic hit the world.
Everybody got locked down, and everybody came home, and everybody started using the internet. And I remember seeing on one of the local fixed wireless providers' websites, they've said, hey, we know you're all staying home, but please don't use too much video, and please don't use too much bandwidth. And I thought, that doesn't work.
The U.S. connectivity gap is far greater compared to countries that are considered its peers economically. Some developing nations actually have better internet than rural America, like in Kenya, which has a state-of-the-art fiber optic network fed in from their coastline. The American connectivity gap does largely affect rural areas that are either outside of service coverage or simply prohibitively expensive. This is Rebecca. She and her family moved to Nevada County just a couple miles down the road from David. They took for granted that high-speed internet would just exist in the area, and it's not something they even bothered to check on before buying their house. Turns out, all they got was dial-up.
We wanted to move where we had a little more space, room for the kids to run around, just be out in the mountains a little bit more. Having come from a bigger city area where Wi-Fi is pretty readily available, we hadn't really considered that in our purchasing of the house, whether that would be an option or not. When school started, and now that we are remote learning with our children and we're doing everything from home, we didn't have the option to do that at our house. So every day when school would start, we'd have to pack the kids up and we'd go to my in-laws' home. They have a little cabin up in this area that does have Wi-Fi already.
Rebecca's situation is the norm in rural America.
According to data from the Federal Communications Commission, just 4% of urban Americans lack access to broadband internet. That's compared to almost 40% of people who live in rural areas. While that was the case, there were also racial and socioeconomic divides in terms of who had that access. In addition to that geographic difference, low-income African American students, Latino students, and first-generation college students were more likely than others to have only one device at home that's shared among multiple siblings and or lack access to that actual connection.
For most American towns, there's also a lack of competition, forcing internet prices up. And large providers like AT&T and Comcast aren't incentivized to expand service to these rural communities.
This is how Xfinity makes life simple, easy, awesome.
So in our area, we have a small imprint of Comcast, but they're not going to go out to the more rural areas. It's just not cost effective for them to do it as a large company.
In order to lay fiber cable, you're actually physically digging trenches into the ground. And for internet service providers, they're primarily focused on maximizing their profits. And so the fewer customers you have, in any square mile and the more fiber you have to lay, that's just kind of harder to pencil out from a purely economic standpoint.
AT&T released a statement on the matter, expressing the need and desire for government assistance to fund fiber optic expansion to areas deemed unprofitable. Comcast released a similar statement encouraging more public-private collaboration on this effort. Federal agencies do offer grants to help communities build broadband networks, but many have argued that there's not enough flexibility on how to use these funds. The COVID-19 relief package passed by Congress in March and signed by President Donald Trump awarded $43.3 million to 51 projects on the East Coast alone. But it also stipulated that these projects needed to be up and running by December 30th. For contractors who plan projects months and years in advance, it's a scramble to rearrange their schedules to meet that deadline.
So what we've been asking the federal government to consider is at least have, as long as the projects are getting started, knowing the projects are being put into place to expand both remote learning, working from home, and opportunities like that that are truly driven from COVID. We're moving as fast as we can regardless, but hopefully they'll give us some more time.
Talking to John Paul, it's clear that he believes broadband is something that can transform a community and should be considered a public good.
One of the first